We go into the European Central Bank meeting, 108.88. We check in on where we are on euro dollar ahead of that meeting. Here's Brent at 80.55, up by 0.6%, Tom.
Bit of a divergent picture across these futures, but it's all pointing lower. A little bit of profit taking after the gains of yesterday. Currently, the FTSE 100 futures pointing lower by 0.3%, standing out in terms of the negativity coming through for the FTSE 100. DAX futures pointing lower by about 36 points, off by 0.2%. And over in France, the CAC 40 is pointing lower by about 11 points so far, Anna.
OK, so we are expecting a little bit of weakness then at the start of the trading day. And as we were saying about the tech sector, that wouldn't be such a surprise, given the strength in tech yesterday. The likes of ASML really pushing the tech sector higher. Those numbers received very positively, at least in the early part of the trading day, by the market. So this is where we are on stocks today, pulling back from some of the strength that we saw in tech names and in other stocks yesterday. So the Spanish IBEX down by 0.4%. The FTSE a little flatter in its performance this morning. We'll see whether we get other markets opening up shortly. As I mentioned, the pound's pretty flat, the dollar's pretty flat, the euro also. So we do see just a column of grey, really, under FX markets, underscoring that we've got plenty of interesting things to find out today, but perhaps we don't know them all yet. So that's the ECB meeting, US GDP, plenty of other US GDP, US eco data coming out as well, and the iPhone number out of Germany. So there's lots in terms of the macro agenda. This is the bond story, and we see these yields coming down a little bit. The 30-year US Treasury yield coming down a touch. You can see that. And there's a lot of focus at the long end and whether those auctions are going to go as planned or as expected. That's not been the case necessarily, where we've seen a couple of lackluster auctions over in the US and also in Japan. And just to flag that there is generally a column of green around commodities. So yes, Brent is higher, WTI a little higher, but elsewhere we're also seeing some moves higher on commodities. Tom, what do you see on the sectors?
Well, commodities and energy is part of the divergence picture that we're seeing across these sectors. Energy is one of the sectors across the 12 main sectors that we monitor that is currently in positive territory, up 0.4%. Not a big surprise, given that Brent is above $80 a barrel. WTI, the last time I checked, above 75. That largely down to a shrinking of inventories, a surprise reduction in inventories in the US. Also partly, it seems, down to the stimulus efforts, or at least the support efforts coming through from Chinese policymakers. Less, it seems, about the geopolitics, but nonetheless, oil is up. Energy as a sector then gaining 0.4%. Here's the tech story then, actually building on the gains of yesterday as a sector, just adding around 0.4% so far in the session. Basic resources also in positive territory, tying into the commodity story that Anna was flagging there, up 0.3%. On the downside, most pronounced coming through for the banking sector, off by 0.6%. Financial services down by 0.3%. The autos as well, down around 0.5%. That's really how it's shaking out so far this Thursday morning. Across your benchmark, you're at 476, just off by 0.1%, Anna.
OK, let's go to one of the top macro stories of the day, and that is, of course, around the ECB. The European Central Bank is expected to keep borrowing costs on hold for a third meeting later today. Joining us now with all you need to know in the run-up to the ECB, Bloomberg's Europe correspondent Maria Tadeo is in Frankfurt for us. So, Maria, on hold, expectations are low that we get any change in overall policy. So what will you be watching out for?
Yes, Anna, and we know, of course, the ECB, as you say, will keep rates unchanged for the third time today. That is the expectation, is fully priced in markets. No surprise on that front. And the focus very much, of course, is now in the future and the rate cuts that we know will come in 2024. The question is when, and for that, Anna, I think that's a real focus in today's meeting. It will be about the language, and it will be about the clues and indications that may come from the head of the ECB. Already, by the way, we had a preview from Madame Lagarde. Remember, she gave an interview to Bloomberg in Davos, spoke with Francine, and then she told us she sees, quote, it is highly likely there will be a move downwards in the summer. Of course, the summer means June. On top of that, it was interesting to see right before the quiet period, the European Central Bank, members of the Governing Council, really come out in force to push back against the idea that we could see early cuts. Potentially, remember, there were some calls that pointed to March. From what I hear, this was intentional. The European Central Bank felt calls were all over the place. Some of them were too early. And obviously, the message that they want to give out so far, the question is how long they can keep it in a credible manner, is that they are not in a rush to cut, and they will not be rushed either by markets to cut.
Well, on that then, Maria, how much clarity do we have at this point around the forcefulness of the language that Christine Lagarde may use at the press conference later today?
Yeah, and Tom, to me, it will be about the tone more than the content, because in some ways, I really struggled to see what else could be new in this press conference, just purely because in this effort to talk to markets at the start of the year, maybe change some of the pricing, we did get so much ECB speak before the quiet period started almost a week ago, so already out there, and the message from the European Central Bank was already out there before this meeting. So to me, it will be about whether or not she doubles down on that message that this is more of a summer situation. That should be the timeline the market should work with. It'll be also interesting, of course, beyond the indications of the rate cut, is whether or not they feel some of the tensions that we've seen play out, especially in the Red Sea. Remember the chaos there. Has that got any implications in terms of the inflation outlook? Do they see upside risks? And of course, remember, they have repeated now for a few minutes that they continue to monitor wage growth as one of the issues that may impact inflation negatively. Is that still something that they see, and how closely do they monitor that?
Thanks very much, Maria. Bloomberg's Maria Tadeo at the ECB for us in Frankfurt. We'll be bringing you live coverage, of course, of the ECB's policy decision. That comes at 1:15 p.m. UK time, and the news conference with ECB President Christine Lagarde is, of course, half an hour later.
OK, for more on what to expect from the ECB and European markets more generally, I'm pleased to say we are joined by Sfir Salem, Head of European Rates Research at Bank of America Global Research. Sfir, good morning. Thanks for joining us in the studio. How forceful do you think the pushback will be then from Christine Lagarde around markets pricing in a cut in April?
I think it will remain quite strong indeed, because the ECB has been quite surprised by the extent to which the market went all on board in pricing those rapid cuts, really starting from March this year. So having seen how far the market went, I think there will be a lot of focus really on trying to anchor the message that was already sent by a few ECB speakers over the last few weeks.
I mean, the overpricing of cuts, if that's what the ECB's view is, that the market is overpricing the sort of cut dynamic, it was a bit of a global phenomenon coming into 2024, wasn't it? It wasn't just about Europe. But it's underscored, I suppose, by the weakness of the Eurozone economy and the pace at which the inflation data has been dropping in the Eurozone. Could you see the ECB cutting before other global central banks?
Well, I think that for us, it's a matter of really your timing of data for the euro area. So I don't think the ECB is really concerned about taking a decision prior to other central bank or delaying it relative to, for example, the Fed. But I think what they're really focused on is getting a lot of information about wage negotiations and the outcome of those in the spring. They also want to see corporate profits, to see the extent to which they will be transferring higher wage bill and higher input prices into maybe another round of price increases. So they want to be certain that this will not happen before delivering the cut. And to us, from a timing perspective, this really points to a June cut. We do expect the Fed to come earlier.
So there's the question of the timing, and then there's the question of the sequencing and the extent that those rate cuts come through. You disagree with the market pricing around April. You think it lands in June. But then in terms of the extent of cuts, do you align with the market, or do you think the market's going and getting ahead of its skis on that front as well? Because currently they're pricing in down to 2.52 by the end of this year on 4% now.
Yes. So on the extent of the cuts, actually that's a really interesting theme, because ultimately I think duration will be driven by exactly the terminal point of the ECB's cutting cycle. There we might disagree a little bit with what is priced for 2024, but ultimately we think that the ECB will be forced to cut well below 2% that is priced in at the moment by the market.
Why do you expect that? That's quite, that's back down to, others would say we're in different times now. The inflation dynamics are just not going to allow central banks to get rates as low as they were post-GFC. But you're suggesting that we do go down to rates post-GFC.
Yes. I mean, at the end, we don't think that COVID has really changed the narrative in terms of neutral rates in the euro area. So if you look at where we stood in 2019, ECB staff work suggested that at maximum neutral real rate was -1%. So neutral nominal, 1%. We think that's really where the ECB is going to be headed. It might pause at some stage at 2% because they have been telling us that they believe neutral is there. But we believe inflation will continue to fall towards 1% in 2025, and that will force another round of cuts towards...
Okay, a 1% view on inflation for 2025. Where does that leave you in terms of positioning on the curve then?
So we think that ultimately the belly of the curve will outperform relative to what's priced in. We expect that this slow repricing of terminal rate that will occur over the next few quarters will ultimately help anchor the 5-year and 10-year rate lower than what the market is expecting for year-end.
Okay, Sophia, thank you so much for setting up the conversation for the ECB meeting later on today, and indeed the ECB trajectory beyond that. Sophia Salim, Head of European Rates Research at Bank of America Global Research. Coming up on the programme, your movers, including ST Micro, shares fall on the company's dim sales outlook. That's next. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. ECB decide to cut rates.
We are on the right path, but I'm not going to shout victory.
Bloomberg Television brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
The wages issue is what I think the ECB is really focused on.
June is our base case.
There is still a 50-50 chance of a rate cut coming just slightly before that.
In many ways, they should have been cutting already earlier to stimulate growth.
The ECB decides today on Bloomberg Television.
This is Markets Today. We are 13 minutes into the European trading day. Let's check in on some of the individual stocks then on the move with Joe Easton. Joe, what's standing out to you?
So we are seeing weakness as expected in ST Micro over in France. The company warning of a 15% decline in orders in the chip space and also missing on its guidance for the year ahead. And as such, we're seeing a read across in a number of peers, including Infineon in Germany and Soitec over in France as well. All of them getting hit. We saw yesterday that weak report from Texas Instruments weighing on the sector, and we're seeing that theme continuing today. But Nokia surging at around 7% at the moment, an uptick in some of their orders, a potential stabilization in some of their 5G infrastructure. That has been a big concern for that firm, and also Ericsson as well. So we're keeping an eye on both of those stocks today. Nokia results getting a good reception, a good signal. Tom and Anna thought I was going to do chip puns, but I've thrown in some telecoms puns instead as well. I'll keep chipping away though. SEB, so SEB, now that one was actually higher over in Stockholm, but it's coming down now up around 0.2%. Actually pretty weak given their expected decline in net interest income. But if we look at the other stocks on this board, they're all in the banking space. We've got UniCredit downgraded at Deutsche Bank today. The bank there thinks that they will be one of the companies hit by that slowdown in yield expectations as well. And Bankinter is kicking off the Spanish bank lending reporting today. Again, it's all about rates. They are coming down, and that is a bad signal. We've got Santander and also BBVA coming up over the next few weeks. That one down 5% in Madrid. And IG Group absolutely slammed in London. This is online trading. They're saying that given the reduction in volatility, the VIX index at a low level at the moment, they're not seeing as many retail traders trading. So they are putting out a bit of a warning today. Also an interest rate impact given all the cash on their balance sheet as well. So IG, the worst performer on the Stock 600 today. Then a couple of others. We had Tod's. This is in luxury out of Milan, doing pretty well on some of those numbers. But Fever-Tree drinks, once again, the drink sector is weak. This one in London is G&T mixers. I'll be needing a couple of them after all of these earnings this week. But Fever-Tree down, again, weak sales, also weakness in the US. That is a bit of a theme for a lot of those companies. Elementis, this is in chemicals in London. Reuters says the company is batting away a takeover approach from private equity, the latest company in the UK getting a bid. And finally, we're keeping an eye on Airbus, given the 5% drop in Boeing overnight as the FAA tells them to stop making more of the 737 Maxes. That one coming up around 0.8%. Keep an eye on those plane stocks today.
Okay, we will. Joe, thanks very much. Joe Easton from our equities team with your regular pun-filled briefing on what's moving this morning. Let's get back to the macro themes. Sophia Salem, head of European rates research at Bank of America, I'm pleased to say, stayed with us this morning. Sophia, we talked a little about the sort of global context to all the rate dynamics. Put the Bank of England in the global context for us as to what we're working our way towards, because once again the same story to some degree has applied. High expectations of rate cuts at the turn of the year, and central banks generally feeling uncomfortable about that. Where does that leave the BOE?
Absolutely. I think it was quite surprising to see how synchronized this pricing of rate cut has been. For the BOE, I'm afraid that on our side, we don't see a rate cut coming as early as for other central banks. We pencil it for August, but really when you look at inflation dynamics, that's the earliest we think they could go. Indeed, looking at services inflation, for example, these measures are falling very fast in the euro area. Instantaneous services inflation, for example, has collapsed to pre-2022 levels, pre-energy price shock. This is not the case in the UK. There is a stickiness in services inflation.
Yes,
that will
and a stickiness in services. And is there a chance the UK avoids a recession then? Because at the turn of the year, a lot of people were talking about a technical recession still being likely. Now, a few people perhaps questioning that post the PMIs yesterday, or not?
Well, yes, I think that in the UK you can get still a very significant dichotomy between growth data and inflation data. The labor market has challenges that go beyond the strength in the economy, and that is really what is keeping pressure on wage growth.
If we take a step back and think about the issuance story, record issuance expected in 2024 from these central banks, from governments and central banks. Governments and then central banks will have their role, of course. How much appetite is there? Is that for issuance? How much risk is there? We've been talking about a lackluster Japanese auction overnight. Is this a red flag? Is this something that could produce a markup in yields that maybe is not being factored in at this point?
That's a very interesting question because it has been the focus of investors in these past few weeks with supply really intensifying. But I would say that the issue at the moment is that we're starting the year in a position that is a bit less comfortable than at the start of last year. Investors are already slightly overweight duration. Last year they were heavily underweight and they had therefore a lot of room to absorb that supply. At this stage, conviction levels are a bit low and they do hold these long positions. So it makes for room in terms of upward pressure in yields coming from that issuance. However, if we think about this year as a whole, we're not too worried in terms of European government bond supply. Because ultimately, if we are moving towards rate cut, a moderate risk of a scenario, that's an environment where investors should allocate more broadly into fixed income. And we really see enough demand there to capture the slight increase that we have in issuance relative to last year.
Okay, enough demand at least for this year to absorb that increased issuance, even as you see a bit of pressure coming through on higher yields on the back of that issuance. Sophia Selim, always fantastic. Thank you very much indeed. Head of European Rates Research at Bank of America Global Research. Coming up, ST Micro earnings disappoint. We're going to take a look at what this means for the prospects of a chip industry recovery. This is Bloomberg.
Is as safe as it was when you were in the government? It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters or your advising?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Could face bigger challenges next.
It was going to keep rate while up. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
Welcome back. This is Markets Today. We are 23 minutes into the European trading day. It's been a bit of a choppy session so far, but currently the European stock 600, the benchmark, is down 0.2%. Earnings is certainly a factor. And ST Micro's fourth quarter sales, well, the outlook has missed estimates in a sign that weak demand for industrial chips is set to continue. Revenue in the first quarter is seen falling 15% from a year earlier. Let's get the details then and the context with Bloomberg's Aggie Cantrill. Aggie, what do we learn then from these results from STM?
Yes, so STMicro's issue really this quarter and going forward into this year with their weaker than expected guidance is about the demand for industrial chips, which is a significant part of their business. We did see that they still have a stable demand within the auto sector and also some recovery, although not fully fully recovered in the personal electronics sector. But really the auto sector remaining stable isn't enough to boost their revenue going forward. The auto sector accounts for about 37% of the business, and the industrials, which is really bringing down their expectations, accounts for 30%. So it's still a significant part of their revenue. And at the moment, with weak demand across the industrial sector, industrial chips, it's a real concern for these companies that supply a lot of heavy industry.
And what can we expect from Intel then? Because we've heard from a lot of European chip makers, in fact, and Asian chip makers of late, and in fact some US names. Intel up next.
Yes, so Intel is up next. What we're going to be looking at from Intel is essentially what we're going to be looking at is essentially how their server industry has recovered, whether they are managing to keep up or are managing to actually approach NVIDIA when it comes to retooling servers with advanced semiconductors. That is a big part of their business, but then also they are looking forward towards these discussions that we've seen a lot of lately about bringing AI capabilities on devices, especially what we've seen these discussions around AI personal computers. And if Intel can really make waves in that space and be able to show that they're committing resources to AI on devices, that will be especially appealing for a lot of investors that are keen to see artificial intelligence capabilities come out of server rooms and onto people's devices.
Aggie, thanks very much. Bloomberg's Aggie Cantrill with the latest on the chip space. And really interesting, Tom, to see the divergence then between the different chip models and what we're seeing then in this earnings story, and the extent to which, and this is where the conversation moves on according to analysts, the extent to which any of them or many of them can monetize the gains that AI no doubt brings. Yeah, and speaking to the CEO of ASML yesterday, Peter Venning, he was very clear that he is seeing that demand. He thinks this is going to be a structural driver for them as they produce these, of course, extreme ultraviolet lithography machines to the foundries like Intel and Samsung and TSMC around the world. He did, by the way, say something is going to break with AI and then we'll regulate around it, which I thought was interesting. We're also watching oil as well today. Yeah, absolutely. Up by 0.6% on Brent, 80.47 currently. So back over 80 on Brent, back over 75 on WTI. We monitor, of course, the stimulus measures coming out of China, tensions in the Middle East, all of that, no doubt, can put upward pressure on oil prices, but we're around $80 right now on Brent. Coming up, we will be joined by Bim Afalami, the Economic Secretary to the Treasury, the City Minister. We'll talk about the UK. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power, the
balance of power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. ECB President Christine Lagarde is seen tempering rate cut expectations at the central bank's first meeting of the year, with policymakers expected to hold borrowing costs steady. Tesla shares slide after it misses on fourth quarter earnings and warns of weaker sales growth for the year ahead. Plus, ST Micro falls as the chipmaker's sales outlook misses estimates on signs of continuing weak demand for the sector.
Okay, we check in then on a sector by sector these markets. Broadly, of course, you are down around 0.2% across the European benchmark after the gains that we saw that came through, led by the likes of ASML and SAP yesterday. Today, across the benchmark, down 0.2%. In Germany, the DAX at 16,838, taking a knock of around 51 points. Here in the UK, the FTSE 100 at 7,512, just down 0.2%. On a sector-by-sector basis, if we flip the screen, the downside really coming through for the real estate sector, down 0.9%. Banks also taking a bit of a hit, as are the autos. So the auto sector is being a bit of a weight there on the DAX over in Germany. On the upside, chemicals coming through with gains of 0.8%. The earnings story, of course, in focus with ST Micro and a disappointment there in terms of the forecast. On the flip side, Nokia coming in with better than expected earnings. Of course, we look ahead on the monetary policy front to the decision from the ECB, or more forward guidance rather than decision. It's expected, of course, to stand pat, but it's the guidance, the language from Christine Lagarde that, of course, will be important to these markets, Anna.
Okay, now let's get to the conversation around the UK. The latest PMIs showed the UK economy performing better than expected in January. However, the same survey from S&P showed firms facing the sharpest jump in costs in 5 months, with attacks on shipping in the Red Sea, also lengthening delivery times. To talk about the UK economy, but also crucially to talk about the role of the City of London and plans around trading venues here in London. Let's welcome to the programme Bim Afalami, the Economic Secretary to the Treasury, the City Minister responsible for financial services in the United Kingdom. Very nice to have you with us, Minister. Bim, if I could start with the sort of outlook for the UK. We got this slightly better than expected data, fast-moving data on the UK economy yesterday. I wonder what the latest thinking is in government about whether the UK economy avoids recession or not.
Well, look, the story of the British economy over the last couple of years has really been continually outperforming the expectations of markets, of forecasters, and you've just given another example. In relation to recession specifically, look, we are hopeful that the action that's been taken over the last year with the budget in last year March, the spring statement in November, which the OBR scored as the biggest, in a 12-month period, the biggest increase to GDP in terms of their own analysis. We're hoping that those things really put us in good stead for 2024. And then when you're looking at inflation still coming down pretty quickly, but we're doing this in a measured, sustained way. And then obviously the Bank of England makes their decisions on interest rates, which, I can't control.
And so there has, of course, been progress on the inflation picture, but we still are a bit of an outlier. Our inflation is still stickier than the inflation that we're seeing in the Eurozone, which is much closer to the ECB's target and certainly away off from what we're seeing in terms of the US. So we're an outlier when it comes to inflation, even though progress has been made, well above the BOE's target. How much concern is there within Whitehall amongst your team about potentially further increases in inflation coming through from the Red Sea? We've seen carrier and shipment costs jumping more than 100% in some terms. Is that a concern? Is there a risk of inflation moving higher?
Well, everybody should be concerned about what's going on in the Red Sea. The action that the Prime Minister has taken with the United States and others on the Houthi rebels is strongly supported, not just in government, but across the House, because I think everybody recognises that is a difficult situation. At the moment, we are not sort of forecasting that will have a huge impact on inflation. But of course, you can't see into the future, and we want to make sure that that situation is resolved as quickly as possible. Just to your first point around whether in some way we're an outlier, that's not really true. We're about the middle of the pack. When you think of the point in the cycle that inflation comes in, we are roughly in the middle. That's obviously not perfect. We'd like to not have, we'd like to be at the bottom of the pack. But broadly speaking, we're delivering on our intention to bring inflation down, and that's happened quite quickly, ahead of where forecasts suggested where we were going to be at this point, and I think that we'll continue in that regard.
Can I ask you about something that I know you're going to talk about later on today, which is something you want to see a renaissance of London's capital markets and unveil a new trading venue, essentially, for privately owned companies. Tell us a little how that's going to work.
So what we've seen across the world is, over the last 5 to 10 years, a gradual structural shift towards more private capital, away from public capital markets. That's happening in every single country, in every single jurisdiction. The prize is to see if we can marry up that trend with our world-beating capital markets and see if you can bring the private and public closer together. And if we can form the sort of space in London where private companies in private markets can access the public markets for periods of time, for specific instances, that could be a real prize that I want us to use our modern technology to try and seize.
Is this because we've seen private markets really growing, of course, and there's some concern in some places that we lack oversight and transparency of what's going on in private markets? So is this aimed at addressing that?
Look, the point about private markets is they are that. They are private. You don't have the same obligations that you do as a public company, and we're not going to change that. I think that the point you make about transparency is an important one, because it's really about seeing the decisions that government can take that helps the broader economy. The more visibility one has about what's happening in private markets, obviously that helps the government make its own decisions. So to that extent, transparency is always a good thing. And if those private companies are able to access public markets in a controlled way. Now, look, it's important to say, the regulators are very involved with how we're going to do this. We're not there yet. But if we can get this right, the prize, I think, for London is significant.
OK, and a lot of these changes will be welcomed by the industry. Some will, though, say it's a little bit too late, given the listings we've seen, big companies, of course, like Arm, notably listing in the US. What would your message be to a tech startup here, maybe with US capital, maybe with UK capital, maybe a mix, looking to list? Why would they want to list in London versus New York, for example?
3 main reasons. The first is, if you are a company that is based here, wants to be here, sees your future as headquartered here, London is the best place for you to be. Come and see us. Come and see Downing Street. Come and see the Treasury. We will talk to you about why we think that London is a great place for you to be.
But if you want to be a global business and you might get a better valuation in New York, you might choose to go there.
That is the assumption of some people, and some people have made that decision. But actually, when the analysis has been done, I've seen this analysis, of what actually happens over a period of time to the valuations of some of those companies, it isn't nearly so rosy as they thought. When they've moved to the US, when they've gone to the US, thinking that it was all going to be the land of milk and honey, and it wasn't. And so what I'd ask them to do is to make sure they consider their home market, because ultimately your home market will give you the truest, best valuation, combined with the reforms that we've done, that I'll talk more about in my speech later, the reforms that we've been carrying out over the last 3-4 years to increase the amount of investment in British business, increase the amount of investment by retail investors, and ultimately make our capital markets match fit for the next 10 years.
There's an expectation, of course, from the polls that Labour will triumph when the election is called, and they have a 20-plus point margin. That won't come as news to you. There is a view as well, being pushed by the Conservative Party, your party, that if Labour get in, they'll raise taxes, they'll make this a less competitive environment. If that's the case, should investors steer clear of the UK until they get some kind of political clarity?
Look, democracies have elections. right? And I don't think we should shy away from that. I don't think we should see that as a negative.
Do you really think Labour is a risk to these capital markets, to the financial sector here in the UK? And if so, how should investors be thinking about that?
Well, I think there are two sides to this coin. I don't want to be overly party political. It's interesting that industry wholeheartedly supports the changes we're making. You're right that they want us to move it faster, and trust me, I want to do that too, and I'm on the phone to the regulators every single day, constantly seeing how we can bring forward these things as fast as we can. But industry supports this. There's broad spread of consensus. So on that level, I actually think these changes are for the long term. You know, this Chancellor is somebody who thinks about the long term, as do I. We're not thinking about the next few months and the election in this regard. But secondly, I'm afraid when it comes to tax, there is a risk with Labour. And I'll be very honest about it. They've said the taxes they're not going to raise, which is income tax, national insurance. That means they're going to have to raise some, because they've got £28 billion that they say they're going to have to spend extra on top of our plans. Now, that £28 billion, I would wager to you, a big part of that, they are planning to look at the financial services sector. We are bringing taxes down. We're improving our regulation.
Not the overall tax load, though, on the UK economy.
Well, we are, actually, and we're bringing that down. Of course, it went up because we had to spend over £400 billion supporting people during COVID, and I don't make any apologies for doing that. But now we are bringing that tax burden down. And I do think with Labour, that £28 billion, they're going to have to get it from somewhere. And by all means, if they come and say they will not increase taxes on financial services, then they should say so. But they haven't said that. Okay. So, you know, they are a risk in that regard.
We will certainly be asking as we get towards the election.
I'm sure you will.
mentioned some new reforms today, and of course we remember the Edinburgh reforms, 31 measures for the financial sector over the last year or so. The Treasury Select Committee, and you talked about cross-party support for some of the things you're talking about here, but there's also been cross-party criticism. The Treasury Select Committee chair saying that the Edinburgh reforms were a bit of a damp squib. How do you stop these reforms you're talking about today from being the same?
Well, I've got huge respect for Harriet Baldwin. She's a friend of mine, but I thought she was completely wrong in that analysis. And actually, if you read the report, as I have, parts of it say you're going quite far and quite fast. Other parts say, oh, it's not going far enough. It's pretty incoherent. And I've comprehensively rebutted what the Treasury Select Committee said. And actually, when you speak to industry, not people who haven't necessarily thought about it fully, with all due respect, when you actually speak to industry, the criticism is, let's go faster. Let's make these things happen more quickly. And I share that urgency with them. And that's one of the jobs that I'm brought in here to do, deliver on what the government's already set out and do it as fast as possible.
Before we let you go, a lacklustre year, of course, for public listings, not just here in the UK, globally, arguably, certainly in the US and Europe as well. Do you expect that to turn around? Are you getting a sense where you've got finger in the pulse, you speak to those within this world, within the sector, you worked in this sector? Do you expect the pipeline around IPOs and listings to come back for the UK this year?
Over the last few days, have been asking precisely the same questions with lots of people in the capital markets who I've spoken to, and they are optimistic. They think that this year is really going to be a much better year than last year. In particular, the prospects, we announced at the autumn statement that NatWest share sale to retail offer to the public, that is going to happen this year. The prospects for that are looking good. The prospects more broadly for IPOs are looking good. And so if you're somebody watching this who's thinking about listing, go ahead, come and speak to the Treasury, come and speak to us, because we are keen to support you on what could be a very exciting turning point year for the capital renaissance of this country.
And you're relying on retail investors to some degree to do that. It's back to the 80s in that regard. Tell Sid.
Well, the funniest thing about Tell Sid is, the truth is, a lot of people, unless they're of a certain generation, don't even remember what Tell Sid was. And I think that's a shame, because I think that what we need to do for a next generation of people, a lot of whom are happy to invest in crypto assets, which are fine, and that's obviously their right, but they don't see the traditional markets as somewhere where they want to invest. And we've got to change that. So the NatWest share sale is one opportunity that we can have to try and catalyse those animal spirits amongst the British people.
Okay, tax cuts in autumn?
You know, I can't say that sort of thing, otherwise I'll get into trouble. What I will say is the Chancellor always keeps taxes under review, and it's our stated position that we do want to bring taxes down over time, as long as the fiscal position allows.
Thank you very much indeed. We appreciate the time.
Problem.
We appreciate it. Thank you. Bim Afalami, of course, Economic Secretary to the UK Treasury. Okay, let's take a look at some of the other stories this morning for your agenda. IBM shares jumping in late trade on a positive outlook for revenue in 2024. The US company also sees free cash flow at around $12 billion, which is above estimates, with sales growth in the mid-single digits. Despite optimistic signals for the pace of corporate tech spending, IBM says it is still planning further job cuts.
The US Federal Reserve is raising the rate on loans to banks issued under an emergency lending program launched last year. The move comes after borrowing from the scheme surged in recent weeks. Effective immediately, the rate will not be lower than that of reserve balances. The Fed's Bank Term Funding Program is due to end in early March.
And the US FAA, the regulator, has halted further increases in Boeing 737 MAX production. That's part of an escalating response to quality lapses at the embattled plane maker. The regulator says a thorough inspection and maintenance process must be performed on each jet before it can be returned to service. Boeing has come under increasing scrutiny after a mid-air blowout earlier this month grounded scores of its MAX 9 planes.
The Danish shipping giant Maersk says 2 container ships carrying US government cargo into the southern Red Sea turned back after a Navy escort intercepted a missile attack. The US military says it shot down 2 of 3 missiles Houthi militants fired from Yemen, while another fell into the sea. The Houthis have continued attacks on Red Sea shipping despite 2 weeks of strikes by US-led forces. Coming up on the programme then, we'll be back to the autos earnings story. Tesla shares in reverse after fourth quarter results, but Elon Musk insists he can see the next major growth wave approaching. More on that next. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Markets Today, 48 minutes into the European trading day. The Stoxx 600 is currently down just 0.1%. Now, Tesla shares slumped in late trade after fourth quarter earnings fell short of expectations, and the EV maker warned of weaker sales growth this year, 2024. During his earnings call, CEO Elon Musk tried to soothe concerns amongst investors about slowing demand, teasing a new low-cost car. For the details, let's bring in Bloomberg's Oliver Crook. Ollie, what else did we learn then from these Tesla earnings? How challenging, how bleak is it for Elon Musk?
Yeah, the way that Elon Musk put it is that you're between basically two huge growth waves. And for the investors, that's not necessarily a very comfortable place. And Elon was talking about how basically there's going to be lower growth this year than there has been historically for Tesla. And that is just basically the headline for them. So they delivered 1.8 million cars last year. They're expecting 2.2. That is what the analysts are expecting for this year. But you know what? That's still 20% growth against a backdrop that is challenging, one, for the auto sector in general, challenging even more so for the EV sector, where demand is starting to be a major question. There's the question of interest rates. It was interesting on the call, Elon Musk was saying that basically their margin is going to be directly pegged to what happens with interest rates. If interest rates go down, their margins will increase and they will be better. If they don't, they'll be worse. Simple as that. And there's also the question of the competition from China. So, okay, they wiped off 6% from market cap, yesterday. But again, this is a stock that has performed 1,000% over the last 5 years, the third best performer or the fourth best performer on the S&P, and has a market cap of $660 billion. So it's not really bad news, all things considered, for Tesla.
What more do we know about the Tesla new car? Because the markets may be focused on the sort of backward-looking stuff, but Elon Musk wanted to talk about the possibility of a new car. What do we know about that?
Yeah, so this is something that Tesla has really not focused on at all in the past. Their entry-level car in the United States goes for about $45,000. They've talked in the past of maybe getting something to market that's closer to $25,000. So they're talking about a car that would be produced at the end of next year is when they would start the production on that. And really it comes in part when, all these Chinese automakers are coming to market with their offerings, and they're a lot cheaper than Tesla and many of the automakers. But what's interesting is what he had to say about production. Have a listen.
It will be a challenging production ramp. Like I can emphasize, we'll be sleeping on the line practically. In fact, not practically, we will be. But I am confident that once it is going, it will be head and shoulders above any other manufacturing technology that exists anywhere in the world. It's next level.
And so one thing to remember with Elon Musk is, yes, he's known for Tesla and bringing the EVs to market, but what he also brought to market was a completely new and more efficient way to manufacture cars. And if that's what they're working on for this next car, this could be a huge breakthrough. This was a part of Tesla's huge success story. Of course, it carries a lot of risk, but he's done it in the past.
Ollie, he wants to increase his stake in the company. What, does he have 13%? He's the largest shareholder, but he wants more. Why?
Yeah, so this is interesting. There's clearly some fear, and he talked about this openly, about sort of strange activist investors, he said, that could potentially oust him if he doesn't have a bigger stake in the company. So he wants to boost that to 25%. He says he doesn't want total control of the company, but he wants more influence and basically to ensure against getting ousting, which is sort of an interesting idea. And he says in the absence of getting 25%, he sort of teased that he could take the AI technology and the robotics technology outside of Tesla and do it elsewhere. And of course, he had to sell $40 billion of his stake to buy Twitter and deal with some tax issues. I mean, can you guys just imagine a battle royale with Elon Musk in the boardroom of Tesla? It would not be great for Tesla. It might be good for Netflix.
Yeah, absolutely. Sometimes you want to be a fly on the wall, and sometimes you feel you don't need to, because it's all quite out in the open. Oliver, thanks very much. Bloomberg's Ollie Crick with the latest on the auto space and Tesla in particular. More coming up. This is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this, you got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
This is Markets Today. We are 54 minutes into a European trading session that is pretty flat overall, pretty lackluster, slightly weaker, but really not by much. On the FTSE 100, the CAC 40 down a little, as is the Xetra DAX this morning. The Xetra DAX under a little bit more pressure, perhaps. So a lackluster session underway. We're waiting for a lot of set-piece events, though. GDP data out of the US later and the ECB. With that in mind, let's have a look at what is on the agenda. At 9 a.m. UK time, so that's fairly shortly, we'll get the German IFO survey, which is usually one of the most reliable indicators around German growth. Then at 1:15 UK time, as we've been discussing many times, the European Central Bank will announce its rate decision. We're also expecting South Africa's central bank to hold its repo rate, hold it steady in January. LVMH in the luxury space, results will be out there after the market closed today. Bloomberg Intelligence says organic growth from fashion and leather goods will likely stay around 9%, but wines and spirits could continue their post-COVID slump. So a real mixed bag then, Tom. Yeah. There's the luxury earnings story, there's plenty of US data, and these indicators around Germany as well. Yeah, it's a little subdued across the European benchmark right now, just down a little under 0.1%. We have the earnings picture, as we've discussed, feeding into all of this. The oil story, I think, is really important, and it's something that our MLive team have been talking about, the quiet rally that may soon grab more attention. And just looking at today's moves, WTI now up a full percentage point so far in the session at 75.86. Brent at $80.77, up 0.9% at a one-month high. And as you were saying earlier, part of this is down to, it seems, the policy support measures coming out of China. Part of it also seems to be a shrinking in inventories in the US. So does this become more of a concern as we think about the central bank decisions ahead? Yeah, on the Markets Live blog, they're talking about this. Oil's quiet rally, they're calling it. Oil grinding its way upwards, and we certainly see that this morning, increasingly so, in fact, at 80.75 on Brent and above 75 now on WTI. But the Markets Live blog, yeah, certainly asking whether we start to see oil being propelled, or the Brent crude benchmark in particular, to its highest close since November. So we'll keep an eye on oil prices, as you rightly point out, Tom. Okay, that is it for Markets Today. You can get insights, of course, from us and the rest of the team on the front page of the Bloomberg UK website, or by typing TLIV GO on the terminal. US futures pointed to very modest gains of 0.1%. The pulse is next. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware. And that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The ECB President Christine Lagarde is expected to push back on rate cut expectations in the central bank's first meeting of the year, with policymakers expected to hold borrowing costs. We're live in Frankfurt. Well, Tesla shares slide after it misses on fourth quarter earnings and warns of weaker sales growth for the year ahead. And also coming up in our weekly UK show, as elections loom on both sides of the Atlantic, we'll look at the impact of a resurgent Donald Trump on Britain. So let's take a look at the European markets map. The picture overall is, of course, one where markets are trying to digest a lot of the earnings that we had. A lot of the focus will be on what we heard from Tesla last night. So stocks overall falling a touch. Again, there's, I guess, the buoyant mood that we had in the last couple of days really being subdued, as also investors look forward to a meeting of the European Central Bank to see if Christine Lagarde pushes back against market expectations. We also have economic growth out of the U.S. Just on Tesla, it did drop 6% in after hours yesterday, and this is after the electric vehicle maker missed earnings estimates and also flagged slower growth this year. A couple of other things we're watching out for is some of the other earnings, and also U.S. data expect to show that the economy expanded at 2% annualized rate in the fourth quarter. Now, the other piece of news that we have, and we'll be speaking to the IFO president shortly, is that January IFO confidence, business confidence coming in a touch below expectations, 85.2 instead of 86.6. Remember, we had a pretty spectacular panel in Davos last week, where also Christian Lindner, the finance minister, said that Germany is not the sick man of Europe, it's just the tired man of Europe. But later on, we'll be speaking to Clemens Fuß, the president of Germany's IFO Institute. That interview, 9:20 a.m. UK time. So the European Central Bank expected to keep borrowing costs on hold for a third meeting today. For more, we go to a correspondent, Maria Tadeo, who's live at the ECB in Frankfurt. Maria, good morning to you. So I guess market expectations is what Christine Lagarde could really push back against, is cuts further down the line, but we're not expecting really anything big today.
Yes, Francine, and when it comes to the actual monetary policy decision, as you say, it's a hold, it's unchanged for the third consecutive meeting. We see this theme of higher for longer at the European Central Bank. But again, as you repeated, this is about the forward-looking expectations from the central bank. We know that this year there will be cuts to come. The question is when. And on that note, look, we've had two big clues already. One obviously involves you, because it's your interview with the head of the ECB in Davos. She said highly likely, that was a quote, we could see a move down in the summer. summer. That was the first indication that we had from the ECB in terms of the timeline, but also the Governing Council around the head of the ECB before the quiet period, also pushing back against expectations of an early rate cut. Remember, the ECB has been trying to almost push back on markets this idea that you could see one in Q1, almost hinting that no, they will look at a data that would encompass almost the first half of the year. So a lot of this will be about the calibration of the timing of those cuts. So it will be about the language more than the actual decision itself, which, as we know, it's probably going to be another unchanged move from the ECB. But when do we move from here and when do we do it will be the key for the central bank.
Yeah, which is basically, that's why it's all eyes on the press conference, right? Because that could be the more relevant bit, Maria.
Yeah, absolutely. And it will be about the press conference, and it will be about whether or not she doubles down again on this idea of summer is the landing zone for this central bank. And it'll be interesting, too, to see whether she repeats, because remember, when it comes to inflation, she's almost said we're not there yet in order to declare victory. If they do, obviously, that would indicate the rate cuts are coming next. But I'll be interested to see whether she alludes to the chaos that we're seeing in the Red Sea. Is that going to be an upside risk for inflation? And remember, one of the focus points for the ECB has been about wage negotiations and wage inflation. Is that something that she still considers is an area they have to monitor, and in place that already, well, they're not there yet in terms of bringing inflation closer to target on the medium term? That will be the key in terms of the data that they say they monitor before making the next move.
Maria, thanks so much. Maria Tadeo there, of course, at ECB headquarters in Frankfurt. And as always, we'll bring you live coverage of the ECB's policy decision. That's at 1:15 p.m. UK time. The news conference with ECB President Christine Lagarde half an hour later. Now, for more on this and what's moving the markets, I'm delighted to be joined by the Managing Director and Global Chief Investment Strategist at BlackRock, Wei Li. I mean, it's a good day because it's ECB day. It's an even better day when Wei Li comes on to talk to you about it. So, Wei, thank you so much for joining us. I guess the concern with the market is that a lot of the good news about possible cuts has been priced in at the end of last year. So what will be the main driver for markets?
Well, understanding how far and for how long this narrative of immaculate disinflation can run is likely going to be driver for markets and risk sentiment for this year. So if we think about the Fed, we can move on to ECB in a bit, but if we think about the Fed, the December pivot essentially greenlit markets to run away with this immaculate disinflation narrative. We think inflation will fall. In fact, at some point in the US, we think that it could get to target towards the end of this year. But we think that inflation will then rebound because of persistent wage pressure. But markets can only focus on one thing at a time. And evidence of inflation rebound is not going to be clear anytime soon, maybe not in the next 6 months or so, which is why we think that there's room and runway for this immaculate disinflation narrative to run, which is why momentum can continue for a while before we think about kind of resetting to fundamentals.
But so, wait, what does this mean? That actually the Fed and other central banks will be very careful in cutting in case then they have to hike, which frankly would hurt their credibility? Or does it mean that we're going to just get less cuts than's priced in the markets?
We think that we're going to get less cuts than what's priced in the market, especially in the case of the Fed. And we also think that we're going to get the first cut later than what market seems to be hoping for. I mean, today is the ECB day. We'll see if President Lagarde pushes back again on the rate cut timing that currently is looking to start in April. You know, like we still see kind of persistency in terms of the tight labor market, low productivity. Maybe they want to wait until the spring wage negotiation to be comfortable that inflation is indeed falling down durably, and that actually puts it kind of close to the summertime, which is the indication she has recently given out.
So, wait, is there a danger that actually, again, the ECB and other central banks need to push back even harder against markets because otherwise it hurts their transmission mechanism? It's almost like a feedback loop.
Actually, transmission mechanism and how they speak to it will be a key focus area as we think about what to pay attention to from today's ECB meeting. I think they will push back against market pricing, but probably not too much. And in fact, if they push very hard on that, and given for now the macro backdrop is likely going to be characterized by falling inflation, we would actually lean against that. So it's a very delicate dance and delicate balance between kind of market pricing and central bank narrative and the wildly swinging narrative from time to time, which is a pattern that we saw for the entirety of 2023 that we expect to continue in 2024.
I have a lot of questions on earnings, which we'll get to in a second, but the BOJ is fascinating, and I don't know whether, I mean, this is going to be one of the biggest monetary policy experiments after the last 10 years. How are you expecting that to develop?
We do see them exiting the very loose and low monetary environment, which stands in sharp contrast to the rest of developed economies. But they are going to do that very slowly and not try to upset and disturb kind of the market stability around it. So we think that they are going to start hiking in Q2, but gradually and slowly, which is why we think that there is still more room to go in the Japanese equity core, which we like very much. We upgraded Japanese equities twice already last year. We still hold the overweight, but we like it on a currency unhedged basis because of the policy divergence closing a little bit as they now kind of join the party of rate hikes.
Thank you so much. Wei Li, of course, stays with us. We'll have plenty more from Wei Li, Global Chief Investment Strategist at BlackRock. We'll go through some of the earnings and we'll focus a little bit more about some of the main drivers for these markets into 2024. Now, also, Tesla shares continue to slump. Pre-market trading after fourth quarter earnings fell short of expectations. And also, the EV maker warned of weaker sales growth in 2024. Now, the chief executive, Elon Musk, has failed to convince investors to overlook slow growth. More on Tesla's outlook coming up. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
So Tesla shares slumping after fourth quarter earnings fell short of expectations. The EV maker warned of weaker sales growth in 2024. Now, during his earnings call, the chief executive Elon Musk tried to soothe investor concerns or rally them really about slowing demand, teasing a new low-cost car. Well, we're now joined by Bloomberg's Oliver Crook. Ollie, so good to speak to you. I mean, I feel like Elon Musk is really trying his best, but investors are just not buying it yet.
Yeah, the way that he put it is that Tesla right now is between two immense waves of growth. And for investors, that's not always a very comfortable place. And what he said is that growth is going to be slower this year. It's slower than it's been historically. And they delivered 1.8 million cars last year. Now analysts are saying that they might deliver 2.2. That's still 20% growth. And that's not nothing in an environment where the auto industry is dealing with a lot outside of EVs. There's questions about EV demand more generally globally. Obviously, there's this slowdown in China. But he was also talking about the Fed rate. He was saying that basically our margins are pegged to the Fed. If the rates go down, our margins will go up. If they don't, they won't. Simple as that. And there's also the question of the Chinese competitors. So listen, you lose about 6, 7, 8% off of Tesla overnight as a consequence of this. But, Francine, as we always say, context is everything. This is a stock that is up literally 1,000% over the last 5 years. It is the 4th best performer on the S&P, and it's got a market cap of almost $7 billion, bigger than any company in Europe. So, all things considered, not so bad for Tesla.
Yeah, I think a couple of the analysts are saying, look, the outlook was also just too vague. Oliver, thanks so much, as always, with some fantastic reporting. Oliver Kirk there in Berlin. Now, still with us, Wei Li, Managing Director and Global Chief Investment Strategist at BlackRock. Wei, when I look at a lot of the earnings, so without focusing on one specific company, valuations in certain sectors may need to come down this year, maybe.
Valuations may look stretched in the context of rates staying high but likely going to come down. But actually, earnings momentum is what matters for the immediate term. In fact, over the 1-year horizon, valuation matters, but not as much. Over the 5-year and 10-year horizon, valuations matters a bit more. So when it comes to earning, if we look at the AI theme, the tech sector, they are still expected to drive more than 50% of the low-teen growth expected from U.S. equity market so far this year. You and I were both in Davos last week, and what struck me is how much AI is being talked about, not in the context of the tech sector, but thinking about the interplay between AI and other sectors, what it is doing for healthcare, what it is doing for climate transition. So when we bring all of this together, we have the conviction that we're just getting started in terms of the adoption of AI across sectors and benefiting companies with pricing power, companies with a lot of data to play with and to have economy of scale. So we do think that momentum can continue in the current environment for the Magnificent Seven and the tech sector, but maybe even broadening out a little bit as we think about what it means for the other sectors.
Yeah, and I guess and you're right, Davos, it was crazy. Promenade, there were like 6 or 7 stands, and it's usually a good indication or sometimes counter-indication of really the sectors that are doing well or that will do well. But if you have a lot of, some of the big companies or some of the big sectors, do valuations triple if they get AI right, or do they actually shrivel if they don't? Is it like an end-all, be-all?
I think a lot of companies, as we go through this current earnings season, they all talk about AI. They all talk about how it is impacting their future profitability. So actually, it takes real expertise to identify kind of projects and companies that are really having value accretive projects based around AI versus those that just talk about AI, which is basically everybody. So I would even say that the era of generalist investing when it comes to AI and other mega forces that we identified is perhaps over. It really takes deep expertise to identify those projects, which is why, as we think about kind of the next wave of AI investing, greater selectivity, thinking about different stacks. We had the chips and the semis, but data center, infrastructure center, and then the actual applications of AI, that becomes more relevant.
Wait, when you look at some of the geopolitics, and again, it's very difficult to see the big market forces in the markets for the next 6 to 7 months. Like, how do you look at geopolitics and I guess, the crisis, chaos possibilities that would really impact markets? Largely, they've looked through it now.
What we have developed within BlackRock is a geopolitical risk indicator which pays attention to how much geopolitical events are being picked up by brokerage research, by news reporting, and attention is now increasing. And we do think that we're in a new geopolitical regime where if you look at the percentage of trade out of the overall global GDP growth, it's stalling, right? So thinking about kind of the US-China relationship. So we're in a new geopolitical regime. Attention being paid to geopolitical events is increasing, but geopolitical risk premium as priced in by markets is quite flat. And I think here markets are applying an old playbook, which is whenever something goes wrong on the geopolitical front, you just buy the dip because very quickly things kind of recover. But in the context of the US-China spheres of influence moving further apart, we think that being selective instead of kind of automatically, indiscriminately buy the dip is the new approach. So geopolitical risk premium across the board is still quite flat, but certain parts of the market may want to bake that in a little bit more.
So interesting, Wei. Thank you so much, as always, for joining us. That was, of course, Wei Li, Managing Director and Global Chief Investment Strategist at BlackRock. Now, coming up, we'll also be talking to the IFO president as German business expectations worsened for a second month. Wrong footing analysts. So we'll talk about that next. And this is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters or your advisor?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Well, Germany's IFO Business Confidence Index fell in January just as economists expected a rise. The expectations gauge also fell in January, adding to an already tough start to 2024 for Europe's largest economy. Well, I'm very pleased to be joined by the president of the IFO Institute, Clemens Fuss. Mr. Fuss, thank you for joining us. So Germany definitely narrowly avoiding a recession in the last few quarters. Has it now become inevitable that the downturn will persist?
It looks like that. So the data that came in today is certainly a setback, and it's a setback. It's negative data almost across the entire economy. The manufacturing sector is one exception where the data is more stable and things look a little better. But even there, companies are telling us that new incoming orders are low and increasingly a worry. So it's not looking good.
So what does it mean going forward? What's your biggest concern? Do you think actually we'll be in a recession in the first quarter? Will that be negative?
I think that is very likely now. We actually expected a positive first quarter, but with this incoming data, it now looks like it could be a negative growth rate in the first quarter, and that will have an impact on the entire year, of course. Our last forecast said that the economy would be growing at 0.7, and that's increasingly unlikely now with this data. The trouble is we have a very weak reading from the very important services sector now, something that we didn't expect. The positive aspects of the outlook, maybe declining interest rates in the second half of the year, rising wages, all of that doesn't seem to bring a lot of confidence. So the outlook is bleak, certainly for the first quarter.
But we've been waiting for a recovery in the German economy for actually quite some time. What exactly is holding it back?
So what we see in the data is an uptick in uncertainty. We ask company how confident are they that they understand their business outlook, and uncertainty has been growing. We also see in the data that Germany at the moment is an outlier in terms of policy uncertainty. So it seems that the economic policy, the German government doesn't really have a convincing plan about how to address the challenges that have been around for some time. The government has been very busy addressing short-term problems, gas supply and things like that, and has managed that reasonably well. But what's missing is a plan for the medium term, a growth plan. Germany faces a number of problems. Our most important sector, the car industry, is in a phase of transition, of structural change. Our energy-intensive industry, the chemical industry in particular, is suffering from high energy prices, and there seems to be little in terms of a convincing plan of how that can be addressed.
But I guess the expectation is that consumers, Mr. Fuß, could drive a lot of the rebound. Wages rise, inflation goes down. What if this does not happen?
This was one of the hopes for this year, and in a way it's puzzling that consumers don't seem to be spending, although their incomes are rising. So maybe that could be something that comes later in the year, but it could also be that if consumers are also feeling increasing uncertainty about their economic situation, they might hold back spending and save more, and that could add to the gloom in that case.
Mr. Fuß, how worried are you about labor productivity growth? It's been losing momentum.
It's been losing momentum, and this is a key challenge indeed. One of the reasons it is so low could be that bureaucracy is increasingly problematic in Germany. So the burden of bureaucracy means that increasingly companies have to let part of their staff deal with complying with regulations and bureaucracy, and a lot of that bureaucracy seems unnecessary, seems exaggerated, and I guess that's one factor holding back productivity.
Thank you, Mr. Fuß. Clemens Fuß there, the president of the IFO Institute, live in Munich. Coming up, our weekly UK show, the Tories, Donald Trump, elections on both sides of the Atlantic. We have the UK covered. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. and they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Good morning, everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services, and markets. I'm Francine Lacqua here in London. So it's increasingly likely that the UK will head to the polls before the end of the year. Prime Minister Rishi Sunak has said it's his working assumption that there will be an election in the second half of the year. Now, that means a vote here in the UK in the backdrop of an election across the Atlantic. It's the first time that's happened in 6 decades. Now, as Donald Trump races towards a rematch against Joe Biden, how will the former U.S. president's resurgence actually shape politics and conversations in Britain? Well, let's bring in Bloomberg Opinion's Adrian Woolridge and our city editor here in London, Catherine Griffiths. So thank you both for joining us. I mean, I like Adrian's pieces because they're always devastatingly funny and scathing of all those involved. So usually people say, I hope I'm not in Adrian's column this week. I mean, you basically say that, the UK Conservative Party should stick together if they want a chance to win the election, and they're just, pulling each other apart.
They are pulling each other apart, and they look extremely absurd. For 2 reasons I try and say in my column. One is that every single Tory who is interviewed on the radio or the television these days is a knight or a dame. They have this overproduction of honorifics, which sounds very odd. But the second and more important one is that they're acting like a far-left party. They're acting, they're divided into squabbling factions, and their working assumption is the only reason that people aren't going to vote for them in the election is they aren't conservative, they aren't pure enough. They're going for this sort of myth of purity. And it creates a very, very odd impression. I say in my column, it's a combination of Ruritania and student far-left politics.
But so there are a lot of questions on whether Rishi Sunak will lead, the party in the next elections, whether there's going to be a leadership contest, whether the Chancellor stays. I mean, it seems like they're running out of time. Nothing much will change, or am I wrong?
No, you're not wrong. There's a limit to how many prime ministers you can get rid of. And I think they've reached that limit some time ago. I should say that Italy looks incredibly stable compared with Britain. But this week, a Tory former minister who very many people had not heard of, called Sir Simon Clarke, called for Rishi Sunak to go, and there was a bit of a fuss about that. Now, he didn't do this sort of execution very well, and the Tory party has closed ranks a little bit behind Rishi Sunak, and very senior people, all called Sir or Dame, this or that, have said that he spoke out of turn. But nevertheless, there's a sort of this constant drip feed of people rubbishing Rishi Sunak, saying he needs to go. And you're going to get the worst of both worlds, which is that Rishi will lead the Conservative Party into the next election, but he'll be weakened by all this stabbing.
Dame Catherine is really, really outraged by your calling out of dames and knights. When you look, Catherine, at the elections, you know, the timing of the election, which we think will be towards the end of the year. There was talk about April, but maybe towards the end of the year. Well, actually, if it is Trump-Biden, and Trump seems to have this in the bag for the Republican nomination, do his policies, does his way of talking actually influence policies or elections in the UK?
Yeah, I think they do to an extent. I suppose it's on both the Labour side and the Conservative side. You've got Sunak, who, as we've just been discussing, is under all sorts of pressure, may come under further pressure to sort of endorse Trump views that he may not otherwise want to endorse, but he will kind of constantly be asked whether he agrees or doesn't agree. And then on the Labour side, the Labour leader, Keir Starmer, may also come under pressure to disagree with Trump, but of course, if he gains power, he may be then having to work with Trump, so it's very awkward.
Yeah, do you think, I mean, does it actually change at the margins, the conversations had here?
Oh, quite a lot. I mean, I think for exactly the reasons we've heard. I mean, the Labour Party is united in its dislike of Trump, but if you're too vocal in your dislike of Trump, and Trump is the president eventually, that is not very good for our closest ally. The problem with the Tory party is they're very, very deeply divided over Trump. The people, the majority of Conservative MPs really don't like him, but there is a faction of people like Sir Jacob Rees-Mogg who think he's great, he's the bee's knees, and they want a more Trumpified Conservative party. So that's a big problem for Rishi Sunak, who couldn't be more different from Trump in style, but will find it very difficult to distance himself from him.
Adrian also has a very funny column on Davos where he says certainly the pushy people that go to Davos. Catherine and I were there. A lot of the talk was actually on Labour, right, and what they mean for UK business. How did they do?
I think they did do really well, and in a way, I suppose they were always likely to, but they were helped by the fact that Chancellor Jeremy Hunt didn't get in until late at night because he had to stay in the UK for the Rwanda vote, which sort of, in a way, kind of epitomised all of the sort of troubles that the Conservatives are having. But Rachel Reeves, the Shadow Chancellor, Jonathan Reynolds, the business spokesperson for Labour, had a great time. They had lots of meetings. They went to all the fancy parties, I think some with you, Francine, maybe. And
I don't know if they were fancy, but they were late-night ones.
Yeah, and, you know, and they were the talk of the town. But talking to some sort of senior finance people, they like the prospect that they think Labour might bring in terms of sort of stability, which is an ironic state of affairs in many ways. But they also do think that Labour at the moment is slightly trying to have it both ways. They want to court business on the one hand, but they are keeping their cards very close on their actual policies.
Like tax. We don't really know actually what they do with corporation tax.
Exactly what they're going to do with corporation tax. And then also sort of things which might seem a bit niche and kind of rich people's problems to many people, like carried interest, what's going to happen to private equity. The country won't really care if, you know, private equity barons are going to get taxed more. But actually, if you talk to sort of fairly sensible people in finance, they say, well, that's all very well, but if that money really does move, as it well might, then that could be a problem for Labour.
Do we have any indication, Catherine, on when we'll know the policies? Are they crafted, but are they keeping it secret, or are they still trying to figure out their messaging?
I think they are, to an extent, still trying to figure out, but they are keeping a lot secret.
Rwanda, I mean, it was quite a week, right, yes, on the Rwanda vote.
Absolutely.
What happens next?
Well, one thing we'd be certain of, and that is that we will not be sending large numbers of people, or probably even small numbers of people, to Rwanda. This is all really a performance. In fact, by the time that we get the next election, which will probably be in November, this policy will not have any effect. We're having an enormous fight. The Tory party is tearing itself apart about a policy which is symbolic more than anything else. It's not going to have any practical effect.
And Adrian, you had this actually in your column today, which made us, well, it's an interesting quote, so we're going to bring it up. The real challenge, Adrian writes, for purists is not how to minimize the damage in the next election. They have long since decided that the election is lost, but how to make sure that Sunak and his supposed moderate supporters get the blame. They will then be able to capture the party's leadership and complete the Brexit revolution. I mean, is this Rwanda?
This is part of it. This is what it's all about. I mean, for the Brexit people, everything is about sovereignty, getting out of any sort of international court, having complete control over what you do within your borders, getting rid of international relations with other countries that are formalised. So, you know, Trumpism in that sense, but also a broader policy of making Britain great, which will mean a smaller welfare state, which will mean, I think, you know, much more encouragement for people to have children, for example. That's one of the big worries that they have in population decline, a much more restrictive attitude to immigration. These people on the right of the Conservative Party have a vision of a conservative revolution, and that's what they want to push through. And winning the next election, which they're not going to do anyway, is nothing to them, really. It's what sort of Conservative Party we have.
Do they want afterwards? Catherine, what's the mood amongst investors? I mean, I know, you know, in certain meetings they do ask about Rwanda because they can't really get their head around it, and so they say, look, do I want to be invested in this country that's trying to do these things against the will and kind of like, you know, challenge the legality? But a lot of them also say, if you look at both parties, they're actually fairly middle, or there's not that much of a difference between policies of Labour and Tory.
Yeah, very much so. I think the sort of feeling in the last few weeks before this latest blow-up in the Conservative Party was that feeling of, well, actually, in this year of massive elections, the UK, the choices are okay. But if these things do, when they flare up, things like Rwanda, and any sense in which there's the rule of law is being kind of undermined, international investors absolutely hate it. But I think this point about sovereignty is so fascinating because actually, I think investors think about it in those terms too, that on the one hand, there's been this huge sort of desire for sovereignty, but on the other hand, well, okay, here you are, we have it now. And actually, therefore, people who rule this country need to take responsibility for what that really means. So for many years, the governments may have had sort of various different ideas, but in a way, we were kind of cushioned by being in Brussels and being in the EU. And again, to take this policy, say, on private equity, well, actually, really, if the Labour government really did decide to kind of radically alter that tax rate, well, this is sovereignty in action. We are a standalone country now, and we will actually see what happens to sort of real implications in the business world.
Catherine and Adrian, thank you so much. Both stay with us. We'll have plenty more, of course, also from our interview with the UK City Minister, who says Capital Renaissance is coming to London. This is Bloomberg.
Tag on the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
company that is based here, wants to be here, sees your future as headquartered here, London is the best place for you to be. Come and see us. Come and see Downing Street. Come and see the Treasury. We will talk to you about why we think that London is a great place for you to be.
But if you want to be a global business and you might get a better valuation in New York, you might choose to go there.
That is the assumption of some people, and some people have made that decision. But actually, when you've done when the analysis has been done, I've seen this analysis of what actually happens over a period of time to the valuations of some of those companies, it isn't nearly so rosy as they thought. When they've moved to the US, when they've gone to the US, thinking that it was all going to be the land of milk and honey, and it wasn't. And so what I'd ask them to do is to make sure they consider their home market, because ultimately your home market will give you the truest, best valuation, combined with the reforms that we've done, that I'll talk more about in my speech later, the reforms that we've been carrying out over the last 3-4 years to increase the amount of investment in British business, increase the amount of investment by retail investors, and ultimately make our capital markets match fit for the next 10 years.
There's an expectation, of course, from the polls that Labour will triumph when the election is called, and they have a 20-plus point margin. That won't come as news to you. There is a view as well, being pushed by the Conservative Party, your party, that if Labour get in, they'll raise taxes, they'll make this a less competitive environment. If that's the case, should investors steer clear of the UK until they get some kind of political clarity?
Look, democracies have elections, right? And I don't think we should shy away from that. I don't think we should see that as a negative.
Do you really think Labour is a risk to these capital markets, to the financial sector here in the UK? And if so, how should investors be thinking about that?
Well, I think there are two sides of this coin. I don't want to be overly party political. It's interesting that industry wholeheartedly supports the changes we're making. You're right that they want us to move it faster, and trust me, I want to do that too, and I'm on the phone to the regulators every single day, constantly seeing how we can bring forward these things as fast as we can. But industry supports this. There's broad spread of consensus. On that level, I actually think these changes are for the long term. You know, this Chancellor is somebody who thinks about the long term, as do I. We're not thinking about the next few months and the election.
Bim Al-Falami there, the Economic Secretary to the Treasury, the City Minister responsible for financial services here in the UK. Now, still with us, Bloomberg Opinions, Adrian Woolridge, and our City Editor in London, Catherine Griffiths. Catherine, I mean, the concern is that he's basically saying that London is a place to be, right? That New York is not as rosy as we think it is. But there's so many question marks about the City of London.
Yeah, there are a lot of question marks. I think, you know, and we know the arguments. There are some very compelling arguments for London, that sense of it being the sort of true international home of capitalism, unlike New York, which is sort of obviously an enormous powerhouse, but has historically not had that sort of international feel. And I suppose that's the debate that is now raging as to whether London is losing that international epicenter feel. I think in Davos, with the global elite, as we were, there was a sense that among the sort of the bankers, of course, they're desperate to find candidates for IPO, and of course they can IPO people in the US or the UK or indeed elsewhere. And then if you try to sort of talk to some of the fintechs and the other tech firms, the startups that are British, they like London, they want to list in London, but they have to think about certain things, especially if their trajectory involves growing their business in the US. And then they have to think about, well, can they justify a valuation that they might get in London versus the US?
Yeah, I mean, the other thing that's struck me when speaking to international investors is that a lot of them still think about Brexit. And we've maybe moved on. Do we know what kind of relationship the City of London in a couple of years will have with the EU?
Well, it's very interesting that we're talking about London versus New York. What we're not talking about is London versus Paris. There was this idea that or Frankfurt, everything would move to Paris or Frankfurt. That hasn't happened. So in that sense, Brexit hasn't been a disaster for the City of London. And I think we will get a closer relationship with London, with Europe under a Labour administration, and that would be a good thing. We'll iron out some of the things, and the Brexit effect will die down in terms of antagonism. I want to say one thing about the Labour Party. The Labour Party has one very good thing to offer to global capitalism from the point of view of Britain, which is stability, which we haven't had under the Conservatives, and that's a very attractive thing. But they're doing one very foolish thing, which or promising to do one very foolish thing, which is to basically attack the private schools. In terms of putting taxes, VAT taxes, on school fees, and in terms of perhaps potentially removing their charitable status. Now, one of the big reasons why people want to come here rather than New York is because they think they're going to get a very, very good education and send their children to good British schools. And if that sector is squeezed, if it's subjected to higher taxes, that is a very negative thing to be doing. So I really think they ought to be, if they're concerned with attracting global talent, they ought to be rethinking that policy.
Interesting. Thank you both so much for joining us. Our city editor, Catherine Griffiths, and Bloomberg Opinion's Adrian Woolridge stays with us. Coming up, the next UK government will inherit the most challenging set of tax and spending problems in 70 years. That's according to a leading think tank. We'll discuss that next. And this is Bloomberg.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, aren't you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Well, the Institute for Fiscal Studies says the next UK government will inherit the most challenging set of tax and spending problems in nearly 70 years. Adrian Woolridge of Bloomberg Opinion is still with us and joining us to discuss this as well. Philip Aldrich from Bloomberg's UK economics team. So, Adrian, thank you for sticking around. Philip, welcome to the program. So, you basically wrote a story which is really quite sad reading, right? Saying that the next UK government will inherit the most challenging set of tax and spending problems in 70 years. We've already had a rough 10 years, right, in the past. So how challenging is this going to be?
Well, think about the fact that we've got the debt has gone up to 100% of GDP. 15 years ago, it was about 50% of GDP, and interest rates have gone up from 0.1% at their lowest point to 5.25%. And you put those two things together, you've added about 50 billion of spending, of cost, which is equivalent more or less to the defense budget. So you've got an entirely new, massive department which does nothing, and we've got to cover that. And that is basically eating into all the public services, the spending on public services. So we've got problems with, we've got crumbling public services elsewhere, and is why we have the highest tax burden since in the post-war era. So that's the driving factor behind why the public finances are in such trouble. And yeah, it's how on earth do you deal with this situation, which is now what we have.
And Phil, I guess the problem is that if you're seen as an austerity prime minister, Rishi Sunak really pushed back again. So you have to find some money somewhere to have fiscal space, but actually you'll get hammered for it.
Yeah, well, so the government is trying to find some fiscal space, but that is by sort of making these sort of slightly fictional spending promises for post the election, and as the Office for Budget Responsibility chair said, he says it was generous to call those spending promises fictional because nothing is penciled in, so we have no idea what it is. But the outline of them is for another 5 years of austerity for all departments, effectively, apart from health and maybe one or two others. But this is not like 2010, because 2010 you went into it with lots of sort of, there was capacity within the public services to absorb some austerity. We have no capacity to absorb austerity. So you're making spending promises which effectively are going to be austerity. They've not said that. As the IFS says, we need to be honest about the trade-offs, and we're not hearing that sort of that honest story. And it's going to be. It is. I think what we have turned into is Italy. When we used to look at Italy's public finances and say, God, and the weak growth and high debt, it's effectively what the UK is now, sadly.
I mean, on the upside, the espresso is also better in the UK in the last 10 years. But to stabilize the debt, and if you look at the numbers, right? So debt has soared from 50% of GDP to almost 100% of GDP in the last 15 years. These are numbers in Phil's piece. So, I mean, are tax rises coming? And could this be, something that's actually needed across the G7 world?
Britalia, I think, is the phrase for what we are now. But yes, basically we have a system in which, a situation in which we have an aging population, we have an increased need for defence spending, and yet we have a government that's talking about tax cuts, that want to go into this election on tax cuts, and that is an unsustainable model. So in the long term, we will have to have spending increases of various sorts. We'll have to remain a fairly high tax economy. And the government is still fixated on Thatcherism, on the Thatcher era. It looks back at this era when we were cutting public spending. But the big story about the Thatcher era was it was a period of very healthy demographics, when we had a relatively young population. So we had lots of room to do this sort of thing with basically an aging, slow growth society. And that is not a society that benefits, that can have sustained low taxes.
Phil, is there anything in green investment? I mean, is there a way of actually, I guess, generating money that's unique to the UK?
That's the magic we need, right? So the magic is always productivity. That's what everyone will talk about, is we get productivity. Now, it could be that AI is this magic ingredient, because if you think about how economies like Germany's, they had this productivity surge as you automated manufacturing, as you automated production. Now, in theory, AI is going to automate services. We're a very services-heavy economy. Not all services can be automated to some degree by AI, but some of it can. So you could get this kind of little productivity boost through AI. I mean, again, this is fanciful in a way, but we can hope.
Well, let's hope. Thank you both for joining us, Phil Aldrich and Adrian Woolridge. Also, check out our podcast that comes out today. You can subscribe. I host it with David Merritt and Allegra Stratton. It's out today, and we look at Trump in the UK. This is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate
if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now? I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
This is Bloomberg.
Okay, so you're moving in on me, quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Good morning from our world headquarters in New York. I'm Manus Granny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Tesla disappoints, the stock slides on an earnings miss, and a warning of weaker sales growth for 2024. The ECB is expected to hold rates today. Christine Lagarde pushes back against a market expectation of the first cut in April. And the view from General Atlantic. We speak to the co-president, Gabriel Cayo. He joins us. The firm's push beyond its roots in growth equity. A very good morning. We are careering towards day 6 of an equity market rally if the futures can translate into the cash market. The oxygen is getting mighty thin up here because you are rewarded a plenty of free cash flow. IBM up 8%, Tesla getting trashed by 8% this morning. So this is where you've got to go for quality according to BlackRock. Tesla really did disappoint. There you go, down 7 1/8 at the moment because there is no target for this year. Yes, the cost might be coming down, but it is a lack of visibility that the market has lambasted it for. Of course, keep an eye on the regional banks today as the Fed raises the drawbridge. They cut off the pricing on the emergency loan facility. That's an effective rate hike for the regional banks of 50 basis points. ING say the Fed is cancelling the free lunch. Now, who stole the oxygen? Who stole the oxygen out of the European stocks? It's the chips. I mean, one day it's bid, the next day it's offered. Today it's ST Microelectronics. But there's also a hangover in the auto sector as well from Tesla on the EV narrative. That dissipation of the China EV market is definitely hitting the autos this morning in Europe. Now, Are you brave enough to buy a little bit of China? Gavikel says China stocks are their world's best value proposition. I feel like leveraging up. And it's a state of total panic in terms of the differential between China assets and the rest of the world. Bit of calm there as we go to the close, Danny.
There we go, Manus. Well, let me amp things back up because we all of a sudden care about auctions today. A pretty lousy 5-year auction made the bond market rally turn. We saw 30-year yields go to their highest in a year. 10-year yields, even though they are slightly lower today by about 2 basis points, we are still around the highest level since December. But I should say, because of that rally we've seen in stocks, because bonds haven't been that bad, Manus, in the U.S., financial conditions are their most accommodative in 2 years. That really sets the scene for this spout of central bank decisions we're about to get. ECB on deck. You're a little change today. We're at 108.95 ahead of that decision. Will Lagarde continue the pushback that we saw from her in Davos that a rate cut is not imminent? Finally, Brent crude up about 1 1/3%. That's above $81. It's this kind of quiet rally we've seen in oil, Manus. Those geopolitical conditions setting the stage for that. We also saw U.S. stockpiles falling more than expected too. That added to some of the rally. But Manus, this idea of the equity rally, this huge surge we've seen in tech stocks continuing once again and again to hit new highs. Maybe Tesla brings some of that reality back. But I want to bring us a quote from Ed Yardeni, who says that the S&P may be starting a tech-led melt-up, similar to what happened in the second half of the 1990s. We're wondering whether a bout of irrational exuberance might push the multiple higher, inflating a speculative bubble in the stock market. Manus, we are back on Bubble Watch.
We're back on Bubble Watch. He's nervous about the velocity in this. He's nervous about the speed and the trajectory with which we've seen this pump up. He's still got a year-end value of 5,400. So that's even more bullish than UBS, more bullish than Deutsche Bank, who I spoke to. Today we're trading sub that. This is about whether these valuations can extend. What better person to give us the context around that than Maria Vetmana, Senior Multi-Asset Strategist over at State Street. Good morning, Maria. We're playing your tune, aren't we? Which is, you know, tech is on fire. You're rewarded with free cash flow in IBM. But what about, to Yardeni's point, are you nervous in any way about the speed and velocity to the level at which we are? Or are you saying, actually, you know what? I'm not that bothered about this speed. There's more mileage to go. Good morning.
Good morning, Manus. You're exactly right. I mean, I'm very enthusiastic about tech stocks, have been for years. And I think the key difference between, tech stocks are expensive, no question about it. And tech stocks are very, very crowded. But can they continue going up? I think they can. And really the reason is, and the difference with the tech bubble in the 90s is that tech companies are really have really solid balance sheet. They have a ton of cash on the balance sheet. I think on Bloomberg there was a story about Apple returning its first billion to shareholders in the form of buyback. So those companies really have a lot of cash. So in a world where interest rates are high and companies are squeezed with higher borrowing costs, tech companies, those large mega caps, they're really benefiting. They're earning, their net interest expense is coming down because they're earning on their cash piles.
On the flip side, Manus knows I love my small caps. I get excited every time they rally, and just another, worth saying. I don't provide investment advice. I just, love following the small caps.
He wants a new job at Goldman Sachs in the asset management side. For anybody that's tuning in, go on.
Yeah, this is like my quiet pitch. Is this what the kids call quiet quitting? No, please don't fire me. Anyway. Small caps are down about 3% so far this year, Maria. So many people were enthused at the end of 2023 saying the rotation is in, these economically sensitive stocks can do okay, small caps will come back. Is that dream dead now, Maria?
Well, I'm a lot less enthusiastic about small caps than you, Danny. And I think the reason is exactly what I mentioned earlier is cost of borrowing. Cost of borrowing is really hurting those small cap stocks. They have, for them, it's much more difficult to get funding, much more expensive to get funding. So this kind of the news around the kind of Manus was talking about oxygen being sucked out. Those companies are usually in the forefront of oxygen being sucked out of them. Why tighter financial conditions? So that's my concern. How's it going to get funding? So that it's increasingly bigger and bigger problem.
You're just killing Danny's dreams there. She loves that rotation. To be fair to her now, in Europe, value is 30% cheaper relative to growth. I mean, let's go there. I mean, there's got to be some proposition that growth is rich. You say it can get richer. And we'll talk more about the ECB in a moment. I don't want to go there just for the moment. But in terms of that relationship between China and Europe, Goldman say this is what could, I don't know, put a floor under Europe, or to what extent do you allow the China stimulus, which is 3 trillion yuan since November, invest into any kind of European exposure?
Okay, so let's split the kind of answer in two parts. First of all, China stimulus. I mean, it really looks like it's trying to kind of block the flood. I mean, we have a huge underperformance in equity markets that clearly concerns authorities, so they're trying to support equity market. Yeah. What we know historically, those kind of panicked action usually provide like very short-lived support. I mean, the big problem in China, of course, is slower economic growth, property market being at a difficult situation, and huge kind of political uncertainty in the sense that we really don't know what would be kind of the next policy action. I mean, today is supportive. Like 3 months ago, it was less so. Who knows what's happening now? So uncertainty is huge. So Chinese stocks are very cheap. Very skeptical about this policy kind of package being enough. I mean, it definitely doesn't address growth problems. So China potentially tactical buy, but not more than that. Earnings problems are still there. Growth problems are still there. Will it help Europe? I would be very, again, skeptical about that, because we know we are in the midst of global manufacturing recession. Services sector is kind of okay, supported by labor markets, specifically in US, but Europe is really struggling. It's in manufacturing recession. Okay. So that's really what's happening in Europe, and that's why European equity is really struggling, because Europe is a huge manufacturing exporter. Whom it's going to sell? China is struggling. Consumer demand is slowing. Cost of production Maria, is hard.
As you're setting up your portfolio, I love what you write, that cash plus tech stocks is the ultimate barbell. That last year, institutional investors increased allocation to stocks and cash rather than IT stocks. They should continue doing that this year. Recession risk make focus on safety and quality particularly important. I just want to say that Manus did find this quote from you. I am stealing it because I like it so much. We've heard time and again, cash is going to come out of these money market funds, that it's going to be put to work in risk assets, that this is not the year to be in cash. Maria, why are they wrong? Why does cash still have a place in your portfolio?
I mean, I think we're a lot more cautious than consensus in terms of risk for U.S. economy. For us, soft landing is a very unlikely outcome, because, I mean, what we're seeing right now, and that kind of goes back to what I mentioned in terms of manufacturing part of the economy is really slowing. Services are fine, mostly because labor market is robust. Historically, we've rarely seen just small increase in unemployment. It's usually either no increase or complete collapse. And I think for now, I mean, we'll see GDP numbers today, but it seems that the U.S. economy is still fairly robust, which means that you can't really Fed can't really cut interest rate as aggressively as market is forecasting. So rates will stay higher for longer and create much deeper recession. So that's our kind of central scenario. So if you are kind of going along with that, then cash is important, and it's kind of still giving you for fairly good return. And for more kind of risk-seeking people, tech looks really attractive because it has cash. So you're kind of getting into the cash and growth and earnings. So that's really the combination we really like. And I think that should be kind of a core of investor portfolio.
Yeah, cash is still king. Hey, Maria, we want to talk ECB with you, so stay with us. That's Maria Weitman of State Street. Now, Manus, let's get some of the other top stories that are trending on the terminal this morning. You mentioned this. The Fed is raising the rate on loans to banks issued under an emergency lending program launched last year. The move comes after borrowing surged in recent weeks. Effective immediately, the rate will not be lower than that of reserve balances.
And Bloomberg has learned that the pay for most top bankers at Wall Street firms in Asia fell below $1 million or more, typically earned since the turn of the millennium. Now, at least 20% of managing directors at banks including Morgan Stanley and UBS received no bonus last year. Danny.
The FAA has halted further increases in Boeing 737 MAX production. It's part of an escalating response to quality lapses at the embattled plane maker. The regulator says a thorough inspection and maintenance process must be performed on each jet before it can be returned to service.
David Ellison is said to have made a preliminary offer to buy the Redstone family's media empire. This move will be a way for Ellison to take control of Paramount Global. Now, this is the media giant that owns MTV, Nickelodeon. Coming up in the show, it is ECB Day. They announced the rate decision in just a few hours. We'll bring that to you live on the ground in Frankfurt. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
You're watching Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. The ECB is set to keep interest rates on hold for a third meeting, while at the same time trying to convince investors that cuts are not imminent. For more on this, let's go to Maria Tadeo, who is live outside of the ECB in Frankfurt. Maria, we saw this from Christine Lagarde and really all the ECB policymakers in Davos last week. They want to push back against cuts. How can they do that today?
Yes, Danny, hugely, and you nailed it, because in terms of the monetary policy decision, obviously we know it's going to be very likely a hold unchanged for the third time. This is an ECB that is still on that theme of higher for longer, but of course the zeitgeist, as you say, is about the rate cuts. And right before the quiet period, you did get the head of the ECB, but also many governing council members who came out publicly on the record and also forcefully saying we are not going to be pressured into cutting rates. This is a European central bank that is not in a rush and will not be rushed, most crucially, by markets into cutting early. A lot of that, I'm being told, is because the European Central Bank was concerned about the fact that calls for a rate cut were all over the place, some suggesting even March was on the cards, and they wanted to push back on this idea that this is a Q1 situation. Now, can they convince the market? So far, you've had a head of an ECB, Madame Lagarde, saying this is highly likely a summer situation. Of course, they're focused on that, and they want to see that some of the upside risks potentially to inflation when you look at the Red Sea situation, but also wage inflation and wage growth is contained before they make that move. In terms of the press conference, just very briefly, for the ECB, this will be a successful press conference if they manage to align with the market is pricing to that June timeline. If they not, we're going to get this debate for the many minutes that are to come before they make a move.
Do not crush the dreams of rates traders of the world out there, Maria. You do not want to do. You do not want to do that. Maybe you do. Maria Tadeo in Frankfurt, crushing dreams. Maria Weitman is, of course, with us, but you've got live coverage of the ECB policy decision. That's at 8:15 a.m. Eastern Time. The news conference with the ECB President Christine Lagarde will begin a half an hour later. I'll bring you the other side of that news conference. As I said, State Street's Maria Weitman is with us. If you were to look at the PMI yesterday, that maybe gives them a little bit of ammunition to, as I say, extend and pretend, put us in the holding pattern. But how much of a policy error is it given that Germany is quite literally flatlining?
No, I think, Manos, you're exactly right. So German and other European economies, they do need a cut. They do need the policy stimulus, as I was talking earlier about kind of manufacturing recession. So that would help. But having said that, central banks and ECB in particular really don't like to surprise markets. So given what kind of Maria just said and kind of quoting a lot of ECB policy makers talking about not going earlier than May, I think that would be, I mean, that's very likely what they kind of continue to stress in today's meetings.
We're just looking at some of what European corporates have been saying about inflation. You have grocery firms like M&S, Tesco, Next, a retailer. All of them have been flagging that customers might face higher prices because of what's happening in the Red Sea and the shipment delays. How concerned are you about that, both when it comes to just investing in European stocks, it seems to be a European story for now, and the threat of a resurgence of inflation?
I mean, the Red Sea, I mean, it's something that we obviously have to watch very, very carefully. I mean, so far it hasn't was like a major problems with supply of, like, I mean, usually we think about like energy and oil and natural gas and things like that. So we have still plenty of supply. So it's maybe taking a little bit longer to deliver it, but it's not really the kind of the major problem yet. But obviously with everything geopolitics, we have to be very, very careful. But for now, it's kind of a risk, not like an imminent risk, I would say.
Okay, yeah, a lot to keep in mind this year. Geopolitics, elections. Maria, looking forward to continue the conversations. Maria Weitman of State Street, thanks so much. Okay, before we had to break, a quick check on this bond market because we saw a poor auction yesterday in the U.S. Auction fear is back. 5-year was not received, a big tail on it, and that sent 10 years to the highest of the year. We are coming down a bit, so there is some buying this morning in the U.S., about 1.5 basis points. Elsewhere, gearing up for the ECB decision and the potential pushback on cuts, even though the economy does need some help, as Maria was saying. Your 10-year yield in Germany at 2.37%.
the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week. Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. When will the ECB decide to cut rates?
We are on the right path, but I'm not going to shout victory.
Bloomberg Television brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
The wages issue is what I think the ECB is really focused on.
June is our base case.
There is still a 50-50 chance of a rate cut coming just slightly before that.
In many ways, they should have been cutting already earlier to stimulate growth.
The ECB decides today on Bloomberg Television.
This is Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. Manus, what a good earnings result for IBM. More cash flow, outlook for revenue and cash flow in 2024 is going to be positive. All of that was received with post-market yesterday gaining 8%. We have the numbers crunched. This is the biggest post-market gain it's seen since at least 2004. So some optimism is back for tech.
Yeah, and guess what it is that's driving that within the context between the third quarter and the fourth quarter. They saw generative AI demand literally double. So that just shows you, again, the velocity. We talked about Ed Yardani's view about the velocity. He's kind of about the speed with which we've rallied, but just the transformation in terms of demand. And it is throwing off cash, billions, 12 billion in free cash flow. But of course, there's job cuts.
Yeah, there are job cuts. We saw this yesterday, too, these tech giants. They're doing this restructuring around AI and are having job cuts to make it happen. But hey, maybe that helps margins. But Manus, you know the real story I want to talk about today, the real corporate story close to my heart.
Burrito season.
This is so
brilliant.
Funny to me. I'm just gonna read the headline. I just have to read the headline. Chipotle looks to hire 19,000 people for this year's, quote, burrito season. I mean, what is not every season burrito season?
Well, technically, traditional seasons are spring, summer, winter, and fall. Well, actually, I know fall comes before winter, and then I'm thinking,
not like every
so what
season?
Is burrito season? Burrito season apparently is March to May. I mean, it just sort of beggars belief. Who's going to fill these jobs? I love this line in the story. Now, I really would wonder, Gen Z, the cohort that's 27 and under, can you see them making burritos?
I mean, but everyone, like, you have to understand, people have so much brand loyalty around Chipotle. I feel like you just say,
say it again,
we're going to give you a
Chipotle.
discount at Chipotle.
Chipotle. There's a couple of them in the UK as well, isn't there? The Brits like
Yeah,
it.
they're not as good, though. The ones in the U.S., this is what I'm most looking forward to coming back to the U.S., Manus. It is Tex-Mex, it is Mexican food, it is burritos.
So you won't want that dinner at Nobu. You don't want that lunch
me.
at Nobu that I've booked for you next week,
No.
then? No. Okay.
Now,
That's good. That saves me a few
maybe
dollars.
I'll take that. Are you paying? If you're paying, I'll see you there, Manus.
faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
You're back with Bloomberg Brief. I'm Manus Cranney in New York.
And I'm Danny Berger in London. Here's what you need to know. Tesla disappoints. The stock slides on an earnings miss and warnings of weaker sales growth in 2024. The ECB is expected to hold rates today. Christine Lagarde pushes back against market expectations of a first cut in April. And the view from General Atlantic, we speak to co-president Gabrielle Caillot as the firm pushes beyond its roots in growth equity. Manus, financial conditions in the U.S. are the loosest in 2 years. We're going to get the first chance of pushback against those kinds of conditions from Christine Lagarde today at the ECB presser. In the meantime, some bid coming in to your 10-year, but yesterday yields went to the highest so far this year after a poor 5-year auction. Euro little changed ahead of that ECB decision. Brent crude, this is now above $81 a barrel, Manus. We did have some slowdown in U.S. stockpiles. That added to the rally, but we are the highest of this year, up 1 1/3%. It is still that geopolitical risk, which maybe not priced in as much as some would expect. It is this quiet rally of that sort of idea building.
Well, it's day 6 potentially of the cash markets. Futures are up. So will it be day 6 of where the equity markets in the U.S. remain on the upside? Microsoft at an all-time high. Meta worth more than $1 trillion. But you are battered and bruised if you under-deliver. Tesla down nearly 8%. They wouldn't give any guidance. Yes, things are changing. We know Elon Musk is doing battle with the board. But then look at IBM, the single biggest one-day pre-market that we've ever seen on IBM, up nearly 8%. It's throwing off cash, $12 billion in cash, 7.6% at the moment. What's going to happen with the regional banks? Keep an eye on them. As JP Morgan say, the Fed is shutting the barn door on cheap financing through the emergency loan. Stocks in Europe are lower on the back of the cars, a little bit of a wind and oxygen coming out of Europe on the back of ST Micro's numbers, along with Tesla carrying over into the auto sector there. And China, Hang Seng is up 1.96%. You've got China are the world's best value proposition, according to Gavikel, and they feel like leveraging up. Leverage me up, Danny. That's what I like.
I love that, Manus. You know what I also love? I love what Mario Weitman was saying about tech. I mean, you can't escape the dominance of tech. There's just so much cash there that for her, it's still the investment to be damned with all the bubble warnings.
Yeah, I mean, look, is this exuberance? Is this, solid exuberance? You go back to the 1990s, you look at valuations, in theory, they've got further to run. The argument is, of course, in the 1990s, is that you had a completely different construct of company without profits, with questionable cash flows, and it was a whole different world then. So I question the comparative between now and the valuation stretch of the 90s. Danny?
Yeah, maybe tell that to people who are selling Tesla stock today, though, Manus. Right. On a different note, as I talked about nonstop yesterday, I was in Cannes making Manus jealous while he was in cold New York. I caught up with some deal makers there about the opportunities and risks that lie ahead.
We are in a situation which is extremely fragile. Our portfolio companies have learned to be resilient, have learned to be flexible, and have learned to adapt to the difficult situations.
We've seen periods of dislocation and obviously periods of volatility in the last 15 years. And so I think that will continue to be the case.
A lot of venture has focused on AI. Of course, there is an absolute bubble. It will have effects, AI. That is over the next decades.
Uncertainty and unpredictability of elections will have pressure on deal flow and activity in any given market.
I don't think that when interest rates go down, we're going to see a reduction in demand from institutional investors.
A rate cut shouldn't be a massive change in strategy at all. And if anything, a lot of our portfolio companies have very low leverage, and it needs to come back to fundamentals.
Well, Manus, deal making is certainly back, at least for the private equity firms themselves. Last week, General Atlantic bought PE firm Actis, building up its footprint in sustainable infrastructure. Now the total AUM of GA sits at $96 billion. I'm pleased to say that joining us now is Gabriel Cailloux, co-president and global head of climate of General Atlantic. Gabe, I feel like this was like a perfect deal for your inaugural year as head of climate. But why now? Why this type of big transformational M&A?
Yeah, it was always part of the plan, of course. No, listen, if you take a step back at how we've built our firm over the last 40 years, is we found a very big theme behind the digital innovation, the digital economy, and we've been backing that theme, and it's helped us build a global business. And we started to poke around where we thought there were other meaningful themes that could, one, drive great investor performance and good opportunity for investment. And this energy transition is one that is often spoken about, but is of a tremendous opportunity and scale. And so we think it's the next leg of growth for several years. The need, by the way, is tremendous. I think you've seen the numbers in the statistics, whether it's $1 trillion a year or $3 trillion a year, not all of that is going to be adapted to PE-type returns. But we think it's an opportunity to build a very special franchise.
Are you looking at buying anything else similar?
I think we need to, so we think we found a group of people and a product that's really special with the Actis team. We've known them for years. If you look at how differentiated they are in emerging market, it fits our profile really well. So we want to make this really successful, and I'll answer that question next year.
Okay, perfect. Well, you'll have to join us for that. We'll hold you to it, Gabe. Look, 2023, it was the first year in 10 that deal volume was less than $3 trillion. I mean, it was talked about a lot. You and I talked about it in Berlin last year. It was a tough year. Is 2024 the year of comeback, or is it another slog?
You know, it's interesting. I think people often try to read the in-betweens between public markets and private markets. And obviously, I think what affects private market deal flow most is volatility, for the simple reason that buyers and sellers don't seem to get along on pricing when volatility is so high. And so I think 2022 is the ultimate example of that, and you saw deal flow really collapse. I think 2023, we saw a rebound, and in a lot of programs like ours that are not rate sensitive or credit sensitive, we were back to investing over $6 billion. I think people are starting this year with a much more constructive approach to deal making. Now, some of that is pressures in sellers, and some of that is a hope that capital markets are going to reopen, and that can be a real stimulus.
Gabe, good morning to you. Good to have you with us, and thanks for joining. In terms of where you go next, Danny and I talk about the Inflation Reduction Act here. I'm in New York. She's coming soon. $110 billion worth of clean energy deals got done in the first year's anniversary. And we're curious to know, to what extent will the U.S. play a much bigger landing ground for you in this clean energy manufacturing and the opportunities here in the U.S.?
Yeah, listen, it's a great question. I'd start by saying we think it's a completely global opportunity, and actually the need for electrification and clean and sustainable electricity is a completely global event. And so when you look at Actis, the platform we're buying, where they're differentiated is they've operated in emerging markets for 40 years of their history, including creating more than 30 gigawatts of clean and sustainable energy in emerging markets. That said, the biggest market in the world is the U.S., and so you would expect that there's going to be a lot of deal activity around that. I think there's a danger of relying on incentives from whether it's the Inflation Reduction Act or any other support, right? I think we want to build an investment program and product that will deliver great returns for investors independent of what legislation helps.
Okay, and we'll see how that maybe changes next year. We brought you on to break a little bit of news, so I hope you do. Reports are that you have confidentially filed for your IPO. Can you confirm that, or when would you like to go public in an optimistic world?
Listen, I think if you take a step back and look at what's happened in the private equity industry in the last several years, it's not different than many other services industries, which is it was a period of massive expansion, right? I think now the private equity market manages something like $13 trillion, and it was less than $1 trillion not that long ago. And the number of actors in the market has ballooned from maybe 500 or 600 to thousands. And so I think more than the catalyst of the IPO, I think we're going to go through a phase of restructuring of our industry. And you're going to see winners emerge, and you're going to see people who can't differentiate themselves get consolidated. We think we want to be one of those winners, and we think that as a result, the industry structure is just going to change completely. Now, I think on the IPO market, to me, the more interesting debate really is are the markets going to reopen? Are we finally going to get back to a favorable capital market setting? Because the last 2 years have been very tough, in particular in our sectors in the tech industry.
It's a debate, but we really want to know if you're going public, Gabe.
I can't comment.
Okay, fair enough. Look, well, in terms of the IPO markets reopening, I know one of your portfolio companies, Shein, there's a lot of excitement about this. Finally, another big IPO coming into the market. There was some Bloomberg reporting that investors are selling at a 30% discount before the IPO. Is there some concern that maybe you won't get the valuation that was initially promised from this fast fashion giant?
Listen, I can tell you, so Shein, so I think we have a number of companies that are preparing to go public, and it'll depend really on can we see some stability in capital markets, in particular in the high growth and tech sectors, because there have been very few anchor IPOs that have driven investor confidence. So we're hopeful for that. Shein's a fantastically performing business. So it continues to grow extremely fast. It's globalizing extremely fast. We think it'll be a very successful offering.
And here's the question: where the IPO market? There's this battleground between London and New York. There's a bigger depth here. There's perhaps better valuation. Just look at Birkenstock and look at DMs. There is a difference. So for you, how do you see New York relative to the LSE, relative to Europe? Is it higher price, deeper pools of capital? Is this the #1 destination for you?
That has been the case historically, and actually, Manus, I think it's even more pronounced not in companies of the scale of a Shein or some of the very large businesses. I think what's been a real challenge for investors is the mid-market. The mid-market in Europe right now is a completely illiquid market, and that means that you have some wonderful companies who've listed themselves, trusted their capital structure to the public markets, and are now seeing no liquidity, no support on valuation, no support to do anything. That to us in Europe has been a real concern. We've had wildly successful IPOs in Europe, like Adyen in Holland or others. But we have a whole list of companies today in our portfolio that we think are special businesses that want to go public. And unfortunately, even if they're domiciled in Europe, they are considering the U.S. markets because they're perceived as deeper, better understanding of tech sectors, and as a result, rewarding companies with better value.
Yeah, I mean, we see that again and again. The ARM IPO, a great example of one big, UK-rooted company that went to the U.S. Now, so you mentioned you have some companies you want to take public this year. Is there something specific you're waiting for to jump back into the IPO market, or is it just there's a timeline you've set up, it's going to happen this year?
I think what we worry most about is IPO for us is not an exit moment, right? The truth is you're just starting the next journey of a company's story, right? And so what you really want is to build the right book of investors that are going to support you throughout long periods of times. And I think the tech industry in particular has learned a really valuable lesson in 2020 and 2021, where you saw an avalanche of IPOs. And if you're honest about it today, a lot of those companies should have never gone public. They were too young, too small, weren't prepared for the scrutiny of public markets. I heard Manus make a comment, I think it was maybe you, that unfortunately today's market, when you have a bad quarter, and a bad quarter qualified as not beating estimates, you get punished really badly. When you're a young growth company, it is really hard to predict a year in advance.
Right.
It's really, really hard. And so I think what we're waiting for is a real buy-in from long-term institutional investors that they're willing to back our companies through growth acceleration.
I mentioned Shein. You also have quite a few different Chinese assets, ByteDance as well. We've seen this period in China right now where policymakers are doing a lot to try to re-instill some sense of confidence among investors. How confident are you in China right now? Would you be as confident as to look for more assets to buy there?
Yeah. Listen, we've been in China almost 25 years. It's been a fantastic market for us. We've had great success and performance there. I think if you are able to put aside some of the perceived binary risk of geopolitics, it is probably the best growth buy that you'll see, right? Because investors have fled the country for understandable reasons. We continue to maintain a very constructive approach to that market. Of course, there's certain industries that right now are really difficult to assess, but we believe that there's an opportunity to make tremendous returns in the market. And I think you have to put in perspective what China's been through. Yes, it looks cataclysmic. It's still growing 5%. There's still a very powerful consumer market, and that's what we're aiming.
Okay, the opportunity is there for the brave. Maybe General Atlantic's Gabriel Gao talking the way that it is in China. Great to have you with us this morning. Thanks for giving us the time. Come back and tell us when that IPO happens. Don't worry, you can ring the bell. We'll let you come here when you come to ring the bell. Coming up on the show, Tesla's slowing growth is worrying investors. We speak to Garrett Nelson of CFRA. That's next.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Brief. I'm Manus Cranny in New York, Danny Berger alongside me in London. Tesla stock, it's dropping this morning. The results missed the estimates. It's slowing growth, making investors anxious. Now, our next guest says this: while the bottom line miss was disappointing and uncharacteristic, as the low-cost U.S. EV producer with prices appearing to nearing an inflection point. What can we take away from that? Garrett Nelson is with a senior equity analyst at CFRA. I mean, this is bruising today on the stock, down nearly 8%. You say that we are at some kind of an inflection point on prices. Extrapolate that for me. Have we seen the worst of the price cuts go through? Good morning.
Good morning. Thanks for having me. We do think we've seen the worst of the price declines in the U.S. EV market. If you look in December, EV prices were at a 4% premium to the average of all new vehicles. So versus a year earlier, that premium was over 30%. So we saw dramatic price cuts in 2023. And, it's good to be the low-cost producer, which Tesla is. The good news is their cost of goods sold per vehicle continued to come down for the fourth straight quarter, was just above $36,000 per vehicle in Q4. So we do think we're getting near an inflection point, and Tesla is a company that has a lot of leverage on the upside when prices do bottom. We think this is sort of an overreaction with the sell-off in the stock post-release.
Tesla is one of these stocks that many folks, many Tesla bulls, they justify the valuation by saying, look at how much is promised by Tesla, by Elon Musk. Yesterday was no exception, not just on the cheaper cars, but things like AI, things like robotics. How much of that do you want to price into these shares? Or is that, once I see it, then I can start pricing it in?
There's no question a lot of this future growth, which hasn't even occurred yet in breakthroughs in AI, hasn't even happened yet. So the valuation does reflect events that investors are assuming are going to take place in the future with autonomous driving and so forth. So, our price target assumes a PE multiple of 50 times 2025 earnings. Now, we think that is an appropriate multiple. Yes, it's a huge premium to the rest of the auto industry, but we argue that it's justified. Now, as far as the sell-off in the stock, we think investors really got spooked about their guidance for a lower growth rate in auto sales in 2024. Now, they're coming off a year in which their auto shipments increased by 38%. And we don't think anyone was forecasting that their growth would actually be higher in 2024. So that's why we think it's somewhat of an overreaction. We're at 16% growth in auto sales this year, and we think, most of the street was somewhere in that range of up 10 to 20%, maybe 25% in terms of shipments. So it's really not a huge disappointment.
But have we got a demand problem with EVs or an adoption problem with EVs? This pace of demand is slowing in China really quite aggressively over the past 3 years. Ford is cutting the F1 production. You've got no guidance out of Tesla at the moment. So what is it? Is it demand is not there and it's dropping off, or is it an adoption issue?
We view it as there's a demand issue in EVs, but it's non-Tesla EVs. So, it's the other 45% of the U.S. EV market, which are non-Tesla vehicles. That's really where the demand problem is. We can see the reservation count for Tesla's newest model, the Cybertruck. It's extremely strong. They came out in the release last night and confirmed some of these recent rumors of the new mass market next-gen EV model, where first production is probably going to be beginning in middle of next year. So, that was a big positive and a silver lining in the release. So, but we really view the demand issue as more of a non-Tesla EV problem.
Garrett, another perhaps just little side drama going on is this whole thing about Elon Musk and how much he owns of Tesla. I just want to play you what he said yesterday about it on the earnings call.
I don't want to control it, but if I have so little influence over the company at that stage that I could sort of be voted out by some sort of random shareholder advisory firm.
So he's issued this ultimatum: give me 25% control or I go do an AI startup elsewhere. What do you make of that ultimatum, Garrett?
Sure, he's in a bit of a standoff with the board here. And we really view these recent statements as posturing ahead of his new compensation plan. He does have a court case pending related to the prior compensation package in Delaware, and a ruling will be coming out in the coming weeks or months. But we really view that as posturing. Obviously, the reason why his Tesla ownership has gone down is because he sold a lot of shares to purchase Twitter. But we really view that as posturing, and we're really not too concerned with how it's going to play out. We think the board realizes that if if Musk left the company, that would not be good for any investors.
Garrett, we're going to have to leave it there. Thank you so much for joining us. That's Garrett Nelson, CFRA. Thanks so much for joining us. Tesla shares down 7.8%.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
It's Bloomberg Brief. I'm Danny Berger in London. Manish Kranny is in New York. Let's get you set up for your trading day. Here's a look at what's ahead. It's the main event, the ECB rate decision. That comes at 8:15 a.m. Eastern and followed by President Lagarde's press conference. Then we have a host of data coming out of the U.S. GDP, core PCE, durable goods, initial jobless claims, all of those will come at 8:30. New home sales at 10. Plus, your earnings before the bell include American Airlines, Alaska Air, Southwest, and Intel's results. And Manis, I know you're never too far from LVMH. They'll be reporting at 11:45 a.m. Eastern.
Yeah, you can come. You know, once you hit these shores, you can help the international earnings. Great interview there with Gabe Cahill. I mean, that was a real insight into where real money wants to put to work. What caught my ear was, you know, he doesn't want to rely on the Inflation Reduction Act here in the United States of America. He doesn't want a market that's completely subsidized, and that's not really where he wants to invest his money, or it's one of the caveats that he put out there. But great to get him in, Danny. Well done.
Yeah, and I thought it was really interesting. I mean, the reports are that GA is looking to IPO themselves. He, of course, didn't confirm that. No. But he says, look, we have a lot of companies we want to IPO. The secret, and we can do it this year, is you just don't IPO them too early. He really seemed not concerned about the comeback of the IPO market.
No, and he did qualify in terms of the lack of liquidity for the mid-market IPO in Europe relative to the depth and liquidity that you get here. That's it for Bloomberg Brief. The surveillance team are up next. Good morning from New York and London.
we've been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Fed has not laid out a strategy in a way that's clear. That leaves the markets to overlay their own interpretation.
Everywhere I look, that sense of optimism and the soft landing story, that's definitely what is being priced in.
I think we're priced in Fed rate cuts and rescuing the economy. I think the jury's still out on that.
There really are risks on both sides of the Fed's mandate.
There's data out there. If you put it all together, I think you can create a pretty clean picture for yourself.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowitz, together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 just about unchanged on a 5-day winning streak on the S&P, extending the longest winning streak of the year so far. Look out below for one stock in particular. It's Tesla. The outlook, Bramo. What outlook for Tesla in 2024?
It looks dreadful. The idea that they were selling cars for lower prices last year, at the end of last year, than a year earlier, tells you everything that you need to know. The fact that Elon Musk talks about not really running a car company, but owning a tech company, also tells you everything that you need to know. It's not very fun to own a car company. It's very fun to own a big tech company.
The stock is down by about 8% in the pre-market. Analysts sounding dazed and confused going into the earnings call and coming out the other side. RBC saying the outlook was vague. AMH Morgan Stanley's Adam Jonas saying for 2024, investors and analysts are very much on their own, in the dark at the moment.
Well, also the big concern is we have an EV glut right now. So if Elon Musk is not cutting in 2024, where is there going to be demand for some of these EVs? Because he had to bring down the prices in order to maintain this competitiveness. And now if there's an EV glut and the prices aren't getting cut, why would you go out and buy a Tesla?
If I were a shareholder and the CEO of a company came out and said, I'm not looking for additional economics, I just want to be an effective steward of a very powerful technology, would you feel comforted? Would that be a comfortable feeling? I don't care what your returns are. I care about some highfalutin concept of technology. That's where we're at.
Who are they in competition with? Domestically here in the United States or China?
China, yeah.
This is the issue, I think, right now. Do you want to buy a manufacturer that is in a race to bring down prices against a Chinese maker of EVs? That, for me, sounds pretty difficult.
Which is the reason why it was notable that Elon Musk on the earnings call praised Chinese car makers. He basically said, if there are not trade barriers established, they will pretty much demolish most other car companies in the world, perhaps including Tesla.
He's using the same language that BYD's founder also used last year. He said we were going to demolish the old legends. Everyone in the commodity space has been talking about this. China's going to lead because they have access to the raw materials that build those batteries. At some point, China can say, we're no longer exporting these commodities, buy the car.
Not just that, cheaper labor. Hello, UAW. UAW comes to a big agreement with the big manufacturers here in America, Ford, GM, Stellantis, and all of a sudden, you get this bidding war for talent in America. And Tesla has to start thinking about offering higher wages as well. And for me, Brammer, that complicates the effort even more. To compete with the Chinese manufacturers at the time that this is happening in this industry in America, it gets even harder for Elon Musk and Tesla.
Which is the reason why you see those stocks in free fall. This one Morningstar analyst, Seth Goldstein, came out and said that Tesla is signaling the days of 50 or even 30 to 40% growth year over year are over. The question is there growth at a time where there's not yet enough automation to overcome some of that higher labor cost that you're talking about?
Dan Ives of Wedbush is coming up on the programme in about 10 minutes' time. Don't miss that conversation. I want to sit on the ECB just for a moment. Federal Reserve decision about a week away. European Central Bank news conference later on this morning. The to-do list for ECB President Christine Lagarde in today's news conference. Never mind the economy. Never mind inflation, never mind interest rates. Let's talk about mutiny inside the central bank and also the political questions that will be asked in this news conference after the political statements of the leader herself.
It's a related question, right? How much does Christine Lagarde address the fact that she badmouthed Donald Trump essentially and talked about the need for the European Union to respond to that, while also shoring up some confidence internally with people having dissent? Also, how much did she push back against the Davos news conferences that she held, where she basically was saying that she's expecting a summer rate cut and didn't seem to push back on the market?
Exactly. She told Francine Lacroix, summer is going to be likely. So what is the point of today's news conference? You're talking about the path of potential rate cuts in Europe and what she might say about the U.S. president. She said it all. I don't think there was anything left for her to say, to leave on the table. She did so in Davos. So I'm not really sure what this news conference is actually going to be about.
Christine Lagarde, Volume 3, a little bit later on this morning. Let's get you the price action on equities on the S&P 500. 5-day winning streak on the S&P. Equities totally unchanged this morning. Yields are lower by a couple of basis points. 4.1587 on a 10-year. Lisa, you want to talk auctions?
Yeah.
Sloppy one yesterday.
Yeah, 5-year auction that really, in the parlance, tailed. Basically, it came in, it sold at a higher yield than it was trading before the auction happened. Auctions matter because not only was this a sloppy auction, but it determined the sort of risk-off feel, not in big tech because nothing can harm big tech apparently, but in the rest of the complex of equities. And to me, that tells you, today, 1 p.m., 7-year auction, be there.
I'm looking for TK to walk through the studio
I know,
door
exactly.
and correct you any moment
stop
from now.
it. Yeah, exactly.
He's not coming to correct us anytime soon. Coming up on the programme this hour, Citi's David Balin on the US equity market rally, Dan Ives of Wedbush on Tesla's disappointing quarter, and Brooks Sutherland of Bloomberg Opinion on the latest blow to Boeing. Boeing in the pre-market down by 2.7%. We begin with our top story. The US equity rally continues. David Balin, CIO of Citi Global Wealth, sounding optimistic in his latest outlook, writing, quote, "We expect rolling recessions to end in 2024 as earning growth accelerates. Labour markets have outperformed, but corporate profits are set to recover." David Balin with us around the table. Morning, David.
Good morning.
Where are you looking for that recovery for corporate profits? Sector specific or right across the index?
Well, both in the sense right now. So we very much are of the opinion that all of the S&P sectors will become profitable in 2024, whereas about half of them were in 2023. And what we see happening is sort of a somewhat contradictory. On the one hand, you're going to have labor growth slowing and productivity rising. Also, if you take a look at the market last year, most of the companies were winding down their inventory. So now they're building up inventory. And that is going to allow, that collectively will allow profits to rise. And we're beginning to see in the first quarter, right, the data that's being reported now and last year, that profits actually are on the rebound. We see that starting in the third quarter of last year and extending all the way through 2024.
So tech has dominated over much of the last 12 months.
Absolutely.
Beginning to lean into the cyclical parts of the market a little bit more?
Yeah, absolutely. I think there's value in healthcare, there's value in consumer cyclicals, and there's going to be value in industrials. But the big story is the difference in value between large cap, especially large cap tech, and small and medium-sized growth companies. You can now buy, small and medium-sized growth companies at 15.5 times earnings at a time when their earnings are going to accelerate, in part because of AI and in part because we're coming out of a relatively difficult 3-year period. It's a good time.
Well, does it concern you how sensitive some of these smaller stocks have been to bond yields? I mean, we get a bad auction, all of a sudden they're negative on the day.
Well, this is what's creating, I think, the buying opportunity. We have an enormous amount of cash sitting on the sidelines. Investors are simply not putting a lot of money to work yet. And yet, you don't want to pick your perfect market time because there isn't one. When I think about the interest rate sensitivity, you are right now, in my view, like at almost 420 on the 10-year, with the auctions being what they were yesterday and probably today. You're sort of, again, near these peak rates at the moment, right? You're sort of at that point now because people still worry about inflation. And there's just not a lot of data to support the idea that there is any. So I think that we're at a point now when we're expecting the broader market to really do well, and that's just ahead of us. So it's a good time, for portfolios.
I was speaking with Joe Davis yesterday of Vanguard, and he was talking about the same thing. If you really believe in AI, why wouldn't you buy all the other stocks and all the other industries that are going to benefit from some of these technological advancements in a more significant way? That said, aren't the big tech names kind of priced to perfection at this point, given that they've been the sole place that people have hit out?
So think about it. They had down earnings in 23, down earnings of 22 of almost 25%. Then the big tech earnings were up 40-odd% next year. And your next guest will talk about it. And this year, they're going to be up 25% more. So they're priced fully. But what's not priced fully is the impact, right, of AI on the value of these stocks, their ability to grow faster, and the increased productivity of the people who use their software. All of that is yet to come. It'll affect places like Citi as well. Just the banking sector alone will become more productive because of these tools. And I think that's simply not priced into the market. And that's really not what I'm basing our base rate on. I think that's like a plus for everything.
Let's get you some earnings from Alaska Air. Lisa, let's go through these numbers together. So they've put a price on the grounding of the 737-9 MAX, a $150 million negative impact from that grounding. Lisa, new outlook, 2024 adjusted EPS, $3 to $5. The estimate was $5. So that range, the lower end of the range, much below the estimate this morning.
Yeah, even though they came in the fourth quarter above estimates with earnings per share of 30 cents versus 18 cents. Shares not moving that much. The fact that they've got to quantify what the grounding of the Boeing 737-9 really has done to them highlights the ongoing discussion that we've heard from the executive branch. Loose screws, we don't know what the path is to bring them on. And hey, guess what? The 737 MAX 9 no longer being manufactured for the time being, with the FAA still kind of investigating.
All inspections will be completed by February 2nd. The outlook from Alaska Air, according to Alaska this morning, includes the gradual return of the 737-9 MAX fleet through early February. We're going to get a lot of airlines this morning, aren't we? That's the first one out of the gate.
We're going to be getting Southwest as well, not as affected or as infected at all by this, but definitely the sort of lower priced airlines. There's this question around deals and what the deal environment is going to be. And I say that because there was this concern about some kind of merger within the airline space, JetBlue, and what that's going to do going forward. That was stymied by the courts. How much is the deal environment going to be affected by the political backdrop and the fact that certain deals that might make sense to the airlines are not really coming through the court system?
Paul Taubman is going to catch up with us a little bit later this morning in the next hour. David, can we talk about the prospect of consolidation and maybe introduce the political theme as well? Are we going to put some deals on ice until we get some clarity of what Washington, D.C. looks like in the next 12 months?
I actually think this is going to be an interesting deal year with an acceleration of deals due to the just the latency of what's gone on. You've had such quiet markets for a long time. So I think there are going to be some deals that are going to be easy and that are going to require very little regulatory scrutiny, very much unlike the JetBlue Spirit transaction, right, which got put on ice. So, but in general, you're seeing it. We've seen 8 biotech transactions of size, right, this year already. And we're seeing a bunch of IPOs being planned, out of private equity portfolios for later in the year. So I think there's going to be a general pickup, regardless of what happens in D.C.
I was reading a Savita Subramanian note of Bank of America, and she was talking about how this is a time for idiosyncratic risk more than almost any other. How do you plan for that? Are there industries, are there places that you're looking for that idiosyncratic risk in a new way?
Yeah, so what's become, sort of an obsession on the people who are doing the stock picking is looking at the ability for managements to actually execute their business plan in this environment. Be able to embed AI, increase margins, watch their expenses, and be able to convince you that they can execute, right? And so that's becoming a huge differential in how equities are being priced. And I think that's also ahead of us. So it's a time when you talk about idiosyncratic risk, but you also talk about the benefits, right, of real ability to execute strategy.
David, you're going to stick with us. It's going to catch up. David Bandin there of Citi, just to get you up to speed on some of the price action. Equity futures on the S&P, just a touch positive in the pre-market. Tesla down hard through most of this morning. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Boeing is facing more setbacks as the FAA freezes production of the 737 MAX. Regulators say they won't agree to any request for production expansion until quality control issues are resolved. The move is expected to impact Boeing's bottom line. CEO David Calhoun is relying on the 737 MAX line as a cash cow. Calhoun told U.S. senators yesterday the safety issues can be resolved in a, quote, matter of days and weeks, not months. Tesla under pressure after reporting slowing sales growth, and CEO Elon Musk's pitch to investors doesn't seem to be working. Musk suggests that the disappointing results are temporary, prompting plans to manufacture Tesla's next-gen vehicle at its Austin and Mexico plants starting next year. But investors are skeptical, noting Tesla's handful of price decreases last year ate into profits rather than boosting sales. Fast food chain In-N-Out is closing its first location in the 75-year history. The company will close its only restaurant in Oakland, California in March after a wave of car break-ins, theft, and robberies. Chief Operating Officer Danny Warnick says that although the company has taken repeated steps to create safer conditions, customer and associates are regularly victimized. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. 2 points in the last story. One, best fast food on the planet. No debate, no discussion. Best fast food on the planet. Two, how sad is that?
That is sad, but you realize it's the best food because you're eating it in your car, like the way they deliver it.
No, I go inside. Also,
You eat In-N-Out inside?
yeah, and Janet Yellen, I think, would agree with you because remember at APEC, she stopped there before going to greet Chinese officials.
Ever eaten In-N-Out?
Yeah,
Okay.
LAX,
All right.
just around the corner from the airport. First port of call. Wherever I get to California.
That's it.
Straight round the corner.
And
You're the
last
only
port
person I
of
know who's
call.
ever gotten into
Every
the store,
single
by the way.
time. I'm very polite to the Uber driver. I ask for a favor, and he gets a good
Stop
tip. Can we just stop by In-N-Out? Every single time.
Never knew that about you.
Up next on the program, Tesla leaving analysts in the dark.
That will be a challenging production ramp, but I am confident that once it is going, it will be head and shoulders above any other manufacturing technology that exists anywhere in the world.
That's coming up next on the program, live from New York City this morning. Good morning. You're watching Bloomberg Surveillance.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
From New York City, equities just about unchanged here on the S&P 500. Bond yields lower by 2 basis points, 415.68. Under surveillance, Tesla leaving analysts in the dark.
Tesla is currently between two major growth waves. We're focused on making sure that our next growth wave, driven by next-gen vehicle, energy storage, full self-driving, and other projects, is executed as well as possible. That will be a challenging production ramp, but I am confident that once it is going, it will be head and shoulders above any other manufacturing technology that exists anywhere in the world.
Here's the latest this morning. Tesla missing estimates, warning of, quote, notably lower growth, choosing not to offer full-year targets. A rare move by the EV maker. Dan Ives, senior equity analyst at Wedbush, writing, quote, we were dead wrong, expecting Musk and team to step up like adults in the room and give a strategic and financial overview. Instead, we got a high-level Tesla long-term view with another train wreck of a conference call. Dan Ives, not holding back. He joins us around a table. Dan, good morning to you.
No, great to be
here. You
here.
sound disappointed.
Look, I mean, this was an important call where Musk and the rest of the team needed to step up, adults in the room, give some guidance in terms of what's happening on pricing, the margin pressure strategically. And I'd say train wreck would probably be soft because this was one where the long-term story is intact, but in the near term, they needed to navigate, communicate. They didn't do that. You'll see a lot of pressure on the stock.
Dreadful assessment. Stock is lower by something like 7% in the pre-market. Have you changed your call on the name?
Look, I mean, we're still bullish, but from a fair value perspective, I mean, 350 goes toward probably lower threes, 3 to 315. From a base perspective, because numbers are going to come down, and the biggest issue here is that you didn't give goalposts. Because by not giving goalposts now, the bears are going to run with it. And look, the Bears won last night. The long-term story is intact in terms of FSD, in terms of if you're a believer in EV, which we are, $1 trillion market cap, I do believe is on the horizon the next few years. But in the near term, I mean, this is one where it's a glass half empty relative to how they talked about it. I mean, this was sort of a 101, not how to do a conference call.
I want to understand what the threshold is for you to say sell. Because we have Elon Musk, who just said, as you said, a train wreck of a conference call, was not the adult in the room. He wants 25% of Tesla, or else he's going to walk and go develop some sort of robotics company. If he gets 25% of Tesla's shares, do you say sell?
Look, I think, first of all, I view that as sort of impossible here. There's not going to be a dual-class situation from a share perspective. Plus, he did sell, he had 22% ownership before buying Twitter. So part of that in terms of the board will have some sort of comp package. Right now, it's caught in a legal issue in terms of Delaware. But I think if he gets more voting control, that's something that's going to ruffle feathers. But also the problem here is that the plane's crashing in the near term. And you're talking about salted or unsalted pretzels. And that's the biggest problem relative to what's happening in Tesla is that investors want to have some guidance. Give me some financial parameters, and you didn't get it. And look, and obviously we're huge firm believers, and that's the frustration.
Well, okay, as a firm believer then, what does it do to you that Elon Musk came out and basically said, I don't care if this company makes money. I mean, I'm paraphrasing, but he said, I'm not looking for additional economics, read more money. I just want to be an effective steward of very powerful technology. Does that bother you?
Look, I think in some ways the autonomous is going to be super powerful. And I think even what we saw with OpenAI and Altman, I mean, there's definitely a lot of unintended consequence here. I do believe in Dojo Optimus. I could argue the value going forward from AI is much more than the EV and the actual value today of Tesla. But for Musk right now to kind of exert that, it's agita, it's Harper. It's the last thing as a bull you want to hear, and it does sort of put gasoline on the fire a little, and that's not what you wanted to hear last night. And it goes back to you needed an adult in the room last night, and instead it felt more preschool type conference call.
Isn't this the cost, though, of doing business and investing in a company with someone like Elon Musk at the helm?
Yes and no. I mean, for investors like that, we've seen it for a decade, right? And you understand you take the good with the bad. But now at this point, this was a huge period to sort of walk investors through, give some goalposts. Zach, CFO with him gone, definitely feels a different type of conference call that we're seeing. And as long-term believers in the story, we remain that in terms on the other side. But in the near term, the Bears won, and it's hard to defend. And that's why you're going to see pressure on the stock today, with 2024 being a trough year in terms of margins.
As a long-term believer of Tesla, Elon Musk also said last night that China will pretty much demolish most other car companies in the world. How are you looking at the space overall? He's basically setting Tesla up to be taken over.
Well, I think it's really Tesla and the Chinese EV players, because the price war that's happening, it's a Game of Thrones price war that's happening in Beijing. You're seeing it. I think that was the right strategic move in 2023. 2024, you can't continue to go down that path. At one point, you got to hold serve, And as much as we talk about FSD and everything else, for now, it's about, do you continue to cut prices? We thought 95% were done. We were dead wrong going into that conference call. That was a wrong call. Now it's defending, as a bull in terms of the long-term story.
I'm just listening to this, and David Baden, everything seems to be going on in the wrong direction. You've got costs going up, labour costs domestically in the United States for this industry. You've got prices going down because they're in a price war with Chinese manufacturers, and demand's not holding up. You see that time and time again. Another warning in the last week from the likes of Ford on what's happening in the EV space. How investable is this sector right now for you?
Yeah, I mean, it's really not an attractive sector because it's stuck in this sort of political G2 situation where you have, this overarching idea where, if you take a look at Chinese stock performance now, which is down, 5-year lows, 50% of what it was at that time, they're not about making profits, right? This is a market share war. And so you have a profit-making company against China in a situation where they have control over a lot of the inputs. It's a tough place to be.
So, David, this is a car company, not a tech company to you, right?
It's a car company now. I mean, I agree with Dan that over time, but when you're valuing it today, that's
a big question about the multiple then, Bramo, that's what it is now.
But that's exactly my point. And Dan, I would address this to you, that it seems like right now, anything with tech as sort of the highlight seems to be going far, far and away, and everything else is left behind. Doesn't that feel dissonant at a certain point if this technology is supposed to affect everything else? Doesn't it seem like this is too overpriced and this is too underpriced?
Well, look, I mean, the AI revolution, as we talked about, the new tech bull market that started, we think tech stocks are up another 30% this year. For Tesla, the AI story will be there. But in the near term, you have to stop cutting prices because then you give away margins, and then if Tom Ford starts selling sunglasses at $100 at CVS, can they sell for $1,500 on Madison Avenue? And that's the fundamental problem here that's happening with Tesla.
David, do you want to jump in?
I like that. I'm going to go buy
those. Use that one as well?
I'm going down to the local corner drugstores.
I want to finish on
with me.
on where Lisa went a little bit earlier in the conversation. I think this matters. Dan, I don't think you've articulated it well enough. I'm sorry. What would change your view on this name?
If we started to feel that demand was really falling off, not growing 20%, cutting more and more prices, giving that away, and you felt like it was more of a circus show rather than this more being a trough, bad communication period, that's where we'd have to seriously assess.
Okay. Dan, it's good to see you.
No, great.
Appreciate the catch-up. Just fantastic to get your reaction to that. Dan Ives there of Wedbush, together with David Balin of Citi. The stock, Tesla, down by something like 7%, painted a pretty ugly picture, not just for Tesla. Let's be very clear about this. Tesla, people are still buying that vehicle. I'm talking about what's happening elsewhere in the industry. The likes of Ford, GM, really struggling. If you think Tesla's struggling right now, think of the other manufacturers in this space trying to ramp up production and catch up.
And this is without the imports from China, right? And this, to me, is the key question. What happens if the Chinese manufacturers can sell their electric vehicles in the U.S. at much lower price points? The people who want the transition to a greener future might love that. Business, not so much.
Coming up on this program, federal regulators ramping up pressure on Boeing. We'll catch up with Brooks Sutherland of Bloomberg Opinion in just a moment. That stock is down by something like 3% in early trading, and equities right now more broadly on the S&P 500 positive by 0.1%. Live from New York City this morning. Good morning.
the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Live from New York City this morning. Good morning. Equities on the S&P 500 on a 5-day winning streak, looking to make it day 6. Equities positive by 0.07%. The Nasdaq just a touch negative. Tesla not helping here. We'll talk about that in just a moment. In the bond market, 2-year, 10-year, 30-year. Messy 5-year auction yesterday. Yields higher this morning, lower by 2 basis points on a 10-year, 4.1568. Supply, Bramo, still matters.
Honestly, to me, this is what I'm watching. People say that it doesn't matter. Okay, auctions don't matter until they do. And yesterday did. And not only did you see a sell-off in the bond market, but you saw a sell-off in everything other than tech stocks. And that tells you that as much as people say we've moved on from the Fed, we've moved on from the rates market, there's still the tail wagging the dog.
TK reached out, sent me a message this morning and said he's got things to say about auctions. He's going to join us next week for the Fed special.
Fabulous.
Just to weigh in.
All right, we'll have
Look out
lots
for
of
that.
Fed special talk.
About a week away. In the market right now elsewhere in foreign exchange, the euro looks like this against the dollar. The euro just about positive, 108.89, positive by 0.04%. Under surveillance this morning, the latest ECB rate decision due out at 8:15 Eastern Time. Europe's central bank expected to keep rates on hold for a 3rd consecutive meeting. Investors will be looking for clues of the first rate cut in President Lagarde's comments 30 minutes later. Many expect the ECB could be the first major central bank to cut rates since the global hiking cycle began. I'll say this, though. When you speak to people about the ECB, they're still penciling in the middle of the year. If you go on recent guidance from ECB officials, it doesn't scream March, it doesn't scream Q1, or maybe even Q2. It might be further out.
But right now, in April, the market is pricing in a 64% chance of an ECB rate cut. So here's the issue. How much is she going to push back, and will the market believe her? Because right now, it's essentially just her job to push back against a market that's already gotten ahead of itself with easing financial conditions. Where's the credibility, though? Because you've heard so many different kinds of indicators, and people are just ultimately looking at the data.
For Lagarde, she really has to stick to the summer because she already said that. She put a line in the sand. She has this indication of intent for the summer. So I imagine that's what she's going to stay with unless she wants to just act like Davos didn't happen.
I joked last week that we should send Mike McKee to the news conference. I actually think we should send Anne-Marie to this news conference because the questions about the politics and her weighing in on not just an election, but the US election taking place outside of Europe is still kind of shocking.
It is shocking. It's also shocking because she worked with the former president when she was the head of the IMF. She had some good relationships with Donald Trump, his family members like Ivanka, but now she's weighing in. She said that the last comment she said at Davos, and there was a string of them weighing in on the former president if he was to take back the White House. The last comment was that Europe needs to go on the attack. That was what we heard from Lagarde. In other ways, we heard that from the German finance minister. We heard that from Emmanuel Macron. Europe is really having a moment where they're looking inwards in this mirror and really a reckoning of how they need to shore up their economy.
The euro right now, 108. 87. Check out Tesla. Shares sliding this morning. Elon Musk looking to convince investors a new wave of growth is still ahead. The EV maker missing earnings estimates and warning expansion will be, quote, notably lower. Pressure on market share and margins also ramping up with increased competition in China. Musk placing his bets on a new low-cost car with a price tag closer to $25,000 by the end of 2025. Brammer, that stock is down by 8%.
Two takeaways for me. It's not very fun to be a car company. It's very fun to be a tech company. He's trying to shift gears and saying we're not actually a car company anymore because that's how bleak things look. It's hard to know how he's going to bring things around unless he becomes more of the tech side and less of the car side, because right now the car side is really pressured by China and, frankly, uncertainty about policy.
Oh, squeeze right on both sides.
Yeah.
Look, you've got a cost issue in the United States right now, given what's happened with UAW, and I'm going beyond Tesla. I'm talking about the majors, Ford, GM, Stellantis. Then you've got a price war with a Chinese manufacturer. You speak to David Baird on a Citi. So two views, sell side, Dan Ives, okay? Ultimately, terrible earnings call, but still bullish. Speak to someone on the buy side, David Baird on Citi. He's talking about the sector being almost uninvestable right now because of the challenges coming from both directions.
And maybe that will change, right? Maybe in 10 years when all of the artificial intelligence and machine learning can sort of automatically create things, maybe we'll have a different conversation, but right now he's not alone. And so at what point is Tesla valued as a car company and not as a tech company? Because right now, with the multiples that it has, as you pointed out, it is not being valued as a car company.
Tesla down hard in the pre-market. I want to finish on Boeing, facing a setback from federal regulators. The FAA freezing production increases for its best-selling 737 MAX jet amid the grounding of the MAX 9. However, the regulator is approving a new inspection procedure, putting the jets on a path to resume flights. CEO Dave Calhoun will address investors on the company's earnings call next Wednesday. AMH, you know this. He's facing questions not just from Washington, D.C., but from investors too.
Yeah, that's right. So he's going to have an earnings call, but he's also going to have a hearing in Congress because of what's going on. I find a little bit of confusing, though. The FAA is doing two things at once. It's one step forward in the sense that, in terms of safety, that they're making sure the 737 MAX production increases are going to be halted. But at the same time, they're allowing the airlines to inspect these aircrafts and get them back in the sky.
I hate this story, I'll be honest. I really do. And I'll tell you, because I don't want to be scared of flying. I want this just to be a given. I want it just to be like, you get in, you don't think about it, it goes up, it comes down, you're somewhere new. I just, how many times have we gotten this sort of a plane crashes and then we have to go on as media representatives and say, but it's really safe, et cetera, et cetera.
We don't have to do that, it's not.
But it's like, it's just such a frustration. I don't want to think about a lack of safety in the air.
So you don't want to talk about airlines?
Well, I mean, we have to talk about airlines. It's just I would like them to fix it.
We're going to talk about airlines right now. Alaska Airlines reporting better than estimated earnings, but saying it sees $150 million negative impact from the Boeing 737-9 MAX grounding. The FAA halting production of the company's most important model and laying out inspection procedures. The CEO, Dave Calhoun, on Capitol Hill yesterday, looking to ease concerns.
We fly safe planes. We don't put airplanes in the air that we don't have 100% confidence in. I'm here today in the spirit of transparency to share everything I can with our Capitol Hill interests and answer all their questions because they have a lot of them.
Brooke Sutherland of Bloomberg Opinion joins us now. Brooke, that line there, we fly safe planes. Does the regulator agree?
I think if you have to say we fly safe planes, then you've already sort of lost control of the narrative. And I think the FAA is not messing around when it comes to Boeing. I mean, this latest news is very serious to talk about pausing a production ramp. This is very key to Boeing's financial outlook, the ability to ramp up production and continue delivering these MAX jets. It still has a large number of them sitting in inventory from when this plane was grounded during the MAX crisis, and because of a lack of deliveries to China. It got some positive news on that front that it might finally be able to hand over some of these planes. But if it can't ramp up production, it can't meet that airline travel demand, and that is a big deal for this company. And beyond that, the FAA is auditing its production lines. It's looking into all of its quality control procedures. And I just think, when you start digging around in Boeing, given all of the challenges that we've seen so far, if the FAA is looking for problems, the odds are that they might find one. And I think that creates a risk that this is sort of a prolonged overhang on Boeing's 737 MAX.
Brooke, I've got a very basic question. Do we have any sense of what went wrong in Boeing over the past 5 years that created some of these issues?
I think it's possible that it goes back much longer than 5 years. I mean, I think this has been sort of a building issue, whether you want to go back to the late 1990s, like United CEO Scott Kirby did with the merger with McDonnell Douglas. If you want to go back to 2001 with the decision to move the headquarters away from the Seattle area factories that produce the 737 line to Chicago, and then they've since moved it again to Arlington, Virginia, which is closer to the defense business, but of course even further from Seattle. Or if you want to go, just into the way that they have handled the MAX crisis and sort of the reputational damage that has followed. I do not feel like we've seen that moment of deep-rooted cultural reckoning that should have happened to Boeing after those two crashes. It certainly should have happened before we've got to this point.
How deeper can this inquiry go? Because Secretary Buttigieg yesterday said, quote, right now, everything is on the table. It almost felt like a threat, Brooke.
I do think that you have to think of every single aspect of Boeing's business as being fair game at this point. I think everybody is frustrated, whether it's the FAA, the transportation sector, the airline customers, certainly. And so I think every aspect of Boeing is going to be under a microscope. And that's why I say that when you start digging in and looking for problems, just given the sheer volume of manufacturing issues that we've had at Boeing, I just think that there's a lot of risk there for this company. I mean, the primary purpose of Boeing, why it exists on the commercial side, is to produce and deliver airplanes, and it has not been able to do so on a consistent basis.
It's a huge U.S. exporter. It's also a huge part of the defense, space, and security unit. That part of Boeing is incredibly important for the industrial complex. What does this mean for Boeing versus Airbus?
I mean, I think that's why everyone wants this ultimately to succeed. Boeing is a storied company, but it is a huge part of our economy. Like you said, it is a national champion, and that's why I think everybody wants Boeing to figure this out. And to Lisa's point earlier, the airlines want Boeing to figure this out. The flying public wants to get back to not having to worry about whether or not a piece of the airplane is going to blow off mid-flight. So everybody is incentivized to get to the bottom of this issue. But I think you can't do that unless Boeing really reckons with how we got to this point and starts with sort of a top-to-bottom overhaul of every aspect of its culture, quality control processes, safety standards, rooting out defects. I think that everything needs to be under a microscope, not just from the outside, but also from the inside at Boeing.
Brooke, I'm with you. This conversation is absolutely shocking. Just things you never want to say. We make safe planes. Brooke Sutherland on Boeing there. I just want to get into Southwest just briefly. It looks like, at first look, Bramo, a beat on a top and bottom line. We can get to the price action in just a moment. The stock is down by about 2.6%. EPS at 37 cents. The estimate is 12.
It's bouncing around. First it was positive, then it was lower. But what you are seeing is operating income in the fourth quarter coming in well above expectations, basically triple, $177 million versus the estimate of $42.9 million. Passenger revenue, just a slight beat. Earnings per share, a slight beat. But there really is a question here about whether they've turned the page on some of the issues that they had with some of their systems and a lack of technological kind of adaptation, John, that we were seeing with respect to just its systems with the breakdowns. Have they really moved past at a time where it's incredibly challenging for some of these low-cost airlines?
Here's the write-up from the team here at Bloomberg. The Southwest has again had to trim growth plans for the quarter in response to rising costs and an industry-wide glut of flights that's pulling down fares. Brooke has told us a few times that fares are actually coming down. Bramo, you and I have pushed back, but we can get Brooke Sutherland's view on this. Brooke, just how challenged are things right now for the airlines? Things looked great at the start of last summer. Where are they now?
I think you had a situation where demand was so strong, and so the airlines chased after that. They added a bunch of seats. They had to hire a ton of people because their workforce was so decimated in the pandemic, despite, I might add, getting $50 billion in payroll aid from the U.S. government. But then they overdid it. And, it's not that demand for travel has fallen off a cliff or the consumer is cracking or whatever that narrative might be, but there's just too much capacity right now in the domestic market, and that's why you're seeing that fare pressure. And the reason why that's so problematic is because the airline costs have also gone up in a significant way. We were talking about Boeing. You also have the RTX recall of their engines that affects a huge swath of the Airbus narrow-body fleet. That all means higher maintenance expenses for the airlines. They're also dealing with higher fuel costs in some cases, certainly higher labor costs, and that all leads to a squeeze on the profitability front.
Brooke, appreciate the update and the reaction to that as well. Brooke Sutherland there of Bloomberg Opinion on the latest with Boeing and Southwest as well. Southwest in a pre-market, just slightly negative. As you said, Bramo, dancing around just after the numbers come out in the last couple of minutes.
But they did talk about the rising costs that you were just mentioning, rising labor and maintenance expenses throughout the quarter. Just want to point this out. The carriers' pilots just had this new contract that had a pay raise of 50% over the next 5 years. So, this is really what we were looking for last year. And that's, I think, going to be the story here. When do some of these wage increases and other things really pressure margins in a more significant way? And maybe you're starting to see that come to the fore.
And at this point, they're negotiating with flight attendants. And if you're in a flight attendant union and you're looking at what the pilots got, you're thinking that you have a pretty strong hand to play.
This is all great when prices are going up and airfares are climbing and you've got pricing power. That's not where we're at right now for the airlines. It's a massive change from where we were maybe 12, 18 months ago. That's the story for the airlines this morning. Equity futures on the S&P 500 totally unchanged. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Former Treasury Secretary Robert Rubin warns the U.S. is in a terrible place with regard to its federal deficits.
I think the risks are enormous, and some of them are materializing already, like higher interest rates and effect on inflation, in part, not in full. And others haven't materialized yet, but I think they're out there, and sooner or later will materialize if we don't correct our fiscal trajectory.
Rubin is calling for tax increases to address the deterioration. Pay for most senior investment bankers at Wall Street firms in Asia dipped below $1 million last year. That's the lowest level in almost 2 decades. Bonuses also took a hit. Compensation is crumbling as firms seek to cut expenses amid one of the worst deal droughts ever seen, fueled by rising political tensions and a crackdown on private enterprise in China. British billionaire Joe Lewis has pled guilty to passing inside corporate information to his private pilots and girlfriend. Lewis pleaded guilty to 3 counts of securities fraud at a hearing in federal court in Manhattan Wednesday. The former Tottenham Hotspur owner will be sentenced in March. And that's your Bloomberg Brief. John.
Hey, Danny. Thank you. Appreciate the update. Up next on the program, the ECB decides.
Monetary policy works with a lag. So whatever we do now is going to have an impact in a few months and sometimes a year or 2.
Looking ahead to the European Central Bank decision later on this morning. That's coming up next, live from New York City. Good morning.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Live from New York City this morning. Good morning to you all. Equity futures on the S&P 500 just a touch firmer, up by 0.05%. Another all-time high at the close yesterday. 5 days of gains on the S&P 500. Earnings looking better than good for Netflix. Not so much for Tesla overnight. That stock is negative in the pre-market. Yields are a little bit lower. We're down 2 basis points on the 10-year, 415.49. Under surveillance this morning, the ECB decides.
what many people don't understand is that monetary policy works with a lag. So whatever we do now is going to have an impact in a few months and sometimes a year or two. And we have to take that in account to decide what we do, how long we hold, and what decision we make in due course.
That ECB decision due out 8:15 Eastern Time this morning, with markets expecting rates to stay on hold for a third straight meeting. Bloomberg Economics expecting Christine Lagarde to push back on near-term rate cut calls. The focus will be on Lagarde's words relating to interest rate reductions in the press conference. Bramo, we forecast a rate cut at every meeting this year from June. That would total 125 basis points this year.
All right, I'm going to kill the kicker. We're not going to get anything today, right? I mean, basically, we're going to get a whole lot of word analysis because they're not going to cut rates. They're not going to basically raise them. So it's going to be 4%. Everyone is parsing through what they expect from Christine Lagarde. And Mark McCormick of TD Securities, his team, basically echoing what Bloomberg Economics is saying. Basically, nothing's going to happen today. And basically, the press statement should be exactly the same. But President Lagarde might want to push back a little bit based on the fact that she seemed incredibly dovish at the Davos meeting, those press conferences, and that seems to be the theme. What damage did she do at that meeting, and how much does she have to undo at this one with the little tweaks around the edges, the little smoke signals that she puts up at the conference?
We can talk about Boeing instead if you want.
It's okay.
ECB or Boeing? ECB?
I know, I'm grumpy.
We're going with the
Thursday.
ECB. Sarah Hewen of Standard Chartered joins us now to discuss, not Boeing, Sarah, don't worry, we'll talk about the ECB. What are you expecting from Christine Lagarde in this news conference?
Well, I think as you've already described, we're not expecting any policy change, and that's very much in the market already. So it will be looking ahead. When are they going to start the rate easing cycle? How far does she reiterate what she said at Davos? Because, of course, it wasn't just Lagarde who was talking about summer rate cuts. We've had a number of policymakers, ECB policymakers, also talking about the summer as being the point at which it might be the right time to start the easing cycle. The same story applies, though, as has done in previous meetings. The jobs market is strong, unemployment is low, wage growth is running at 4 to 6% per annum. That's not conducive with inflation being at target. They'll want to see how wage settlement negotiations go over the next few weeks and months, and they're more likely to have a better idea in the second quarter about whether inflation sustainably is on the trajectory to 2%, or whether, in fact, this services inflation, which is still stuck at 4%, whether that's likely to stay high on the basis of high wage growth.
Sarah, that all sounds very appropriate and nice conversation points for Christine Lagarde today, and probably not what anyone is going to be listening for, because they're going to be listening for whether she says markets have gotten ahead of themselves, number one, and number two, what she has to say about Donald Trump. From your perspective, how much are those really going to be the key points in a press conference that, yes, where we are with wages, where we are with inflation, yada, yada, all that nice stuff is basically going to be forgotten because it's all been said before?
It has been said before, but I think she'll want to reiterate it. And she's certainly going to push back against market expectations, which have 2 rate cuts broadly factored in for the second quarter, although the expectations for the current quarter have largely faded away. So there will be pushback. On Trump, I mean, she's just not going to make any comments on the politics. So even though she may be pressed on that, and even though everybody will be waiting to hear, then that's not likely to happen. I mean, she'll be asked about the euro as well, and again, there's a standard response to that. So I'm afraid it is going to be the boring old economics and the boring old data dependency, and just perhaps in more granular detail about what it is specifically they'll be waiting for, especially on the wage front.
Sarah, you might have noticed Lisa's not excited about this one bit. Did Lagarde and the ECB do something to your cornflakes in Davos?
No, I actually think she has a tough thing, but to me, it's just all economics, right? And
Sure.
at this point, she can say whatever she wants, but people are just looking for these key issues. And then they want to see projections and the things that have come out. But otherwise, I mean, honestly, what could she say? It's basically whether she's going to slip up and say something political or whether she's going to say something that pushes back against the markets.
I can't wait to promote this news conference throughout the rest of this morning. Sarah, can we talk about how tight financial conditions are? We all know, based on experience, that the bank lending channel is far more significant and important in Europe relative to the United States. Here in the United States, markets looking easy. Equities are at all-time high, spreads are tight. We've got a lot of issuance coming through the credit market again. Just how tight are financial conditions in Europe?
Yeah, they are tight, and we had that bank lending survey which demonstrated that that was still very much the case, and it's been the case for quite some time. So what Lagarde has said previously about, it takes a while before the full impact of policy tightening takes effect, that's very much being demonstrated in the lending data. If I could just note one other issue that may come up, which of course is what's happening to supply chains, what's happening in the Middle East. That's definitely going to be a question. How far does it affect Europe? Because the impact on Europe, which so far has benefited from falling goods inflation year on year for quite a long time, how far is the jump in freight costs and disruption to supply chains going to feed through to inflation? We already saw that impact in the purchasing managers' indices. Sentiment broadly is weak. How do they balance the lack of confidence in the economy, what the surveys are saying about the risk of the economy essentially dragging along in recession versus the inflation impact of the supply disruptions?
And amongst all those risks, there's also the fact that the IFO data this morning out of Germany, again, business confidence worsened in Germany. Is a rough start to 2024. This is the most important economy in the Eurozone. At some point, do they potentially need to change the timeline because of what is going on in the German powerhouse?
I mean, they will look across the board what's happening to all economies, and Germany has taken more of a hit in a sense than it's used to in these cycles because of its dependence on manufacturing and the impact that high energy costs has had. So we are seeing Germany again skirting recession and at high risk of tipping down into negative for 2 or possibly 3 quarters, according to the IFO data that we had this morning. That's not by itself going to influence the timing of a rate cut, but clearly to the extent that the whole region is struggling, and to the extent, importantly, that the labour market starts to show signs of distress as well, then that will be the point at which policy easing looks more likely.
Hey, Sarah, thank you for your insights. Sarah Hewen there of Standard Chartered. Have we got the promo somewhere? I can bring that up on the screen. I can promote the decision. 8:15 Eastern Time. The ECB decides 30 minutes later. We'll have a news conference with Christine Lagarde that Bramo tells me is going to be absolutely gripping. Gripping. We're going to take it right here live on Bloomberg TV.
It might be really gripping, okay? But I'm just saying, at a time where the economic data is inconclusive and people just keep repeating the same thing over and over again, people are looking for slip-ups. It's essentially what people are looking for. Am I wrong?
You're not wrong. I think it's all about the news conference. I think the decision is likely to be boring. How much has changed given what you said just last week? But the news conference, given the pushback inside we're seeing from the central bankers that work there, the staffers at the European Central Bank, the mutiny, do you want to really jazz it up? That one. Thanks. Okay, 2, the politics. Anne-Marie, the politics, the fact that we've got an ECB president that's willing to weigh in on the politics, not in Europe, but abroad.
And not just once, and then decided, I have another opportunity in Davos, let me walk it back. It started the Friday before Davos in an interview at France 2, saying Trump is a threat. Then she went on to when Francine Lacroix asked her and said, well, actually, let me take a drink of coffee. And then later that week said, actually, Europe needs to go on the attack because we're worried about Trump. I imagine ECB reporter is just going to ask this simple question.
Yeah.
Is it appropriate for a central banker to weigh in?
It's round 3. In the next couple of hours. Coming up in the next hour, Senior White House Advisor Amos Hochstein, Paul Talman, the CEO of PJT Partners, the brilliant Liz Ann Saunders at Charles Schwab, all of that and more. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI,
you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
We're just at the very beginning of heading back towards normal and what normal would be.
My feeling is inflation still comes down. I think we're in the camp that says that we're in a declining trend in inflation.
It is possible that inflation just comes down and we don't go into a recession. But is that the likely case? No, it never has been likely.
Things could change and move around pretty quickly.
We're not out of the woods yet in having a recession.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 just about positive by 0.1% following a 5-day winning streak on the S&P, the longest winning streak of the year so far. A couple of names to talk about. We can talk about Tesla and Boeing in just a moment. Let's start with the big one. I'm going to try and promote this. An ECB decision coming up in about an hour and 15 minutes. Bramo is about to fall off her chair with excitement about it.
It's going to be incredible. Nothing is going to happen. They're not going to move, and they're going to try to not indicate that much. What's going to be interesting, as you've pointed out, is the press conference. Does she get into politics? Does she say something wrong? But essentially, the fact that we're here, that basically people are looking for slip-ups, tells you that things are kind of on hold, and people can sort of angst around this, but we won't know until we know exactly what their path is and what the economic trajectory is.
So she's been criticised within the central bank by the staffers about maybe not being the greatest leader, the greatest boss. I would say on the governing council, they believe she's a consensus builder. So let's talk about people on the governing council right now. Philip Lane, her chief economist, basically said you've got to wait until June to get a feel for what's going on with wages. Hasn't he just told us that he's not willing to do anything until the middle of this year?
Even so, 64% chance being priced into the market right now of an ECB rate cut in April. So not necessarily buying what they're selling. Here's a key question, and actually Sarah Hewen outlined this in a very good way. I am curious to hear what she says about the Red Sea and some of those disruptions. In the U.S., people are saying it's not going to necessarily jack up prices. In Europe, it's a very different story because that really is the major supply chain channel. So that could be interesting.
A lot of those goods that go through the Red Sea actually are destined for Europe, and they're adding a ton of fuel money and a ton of time to go around Africa. And what we've seen is that the U.S. Department of Transportation has told vessels to avoid the Red Sea, to avoid the Gulf of Aden, and until that starts to temper down, you're going to see this play into the supply chain. At some point, it's potentially could hit inflation.
I think Lisa got it done there. 8:15 Eastern time. That was perfect.
you.
Yeah,
I
I'm looking
appreciate
forward
it.
to
The Spark Notes version.
30 minutes later,
As opposed to
you're going to
before.
get a news conference. I mean, before that was quite something in a previous hour, but we'll try and forget that. Let's take a look at Tesla in the pre-market. The stock is down by about 8%. We've heard from the South side. I think they've called the outlook vague, left in the dark, on their own for the next 12 months, trying to figure out what earnings are going to look like.
I gotta say, the fact that Dan Ives, the key bull in technology, the bull on Tesla and everything else, coming out and saying it was a preschool press conference, that he didn't get it done, that it basically was not an adult, is sort of an understatement, gives you a sense of where we are. The fact that we're talking about a company now that he doesn't want to run. He wants to run a tech company, not a car company.
Stock is down by about 8% in the pre-market. The broader price action, equity futures, let's touch base on that. The S&P 500, just about positive by 0.1%. Yields are lower by a basis point or two. 416. I've talked about it twice. You've talked about it twice. Auctions, they matter, Bramo.
Honestly, yesterday, the 5-year auction was so exciting at 1 p.m.
It was sloppy. It wasn't good.
It wasn't good. Today, we've got a 1 p.m. auction. At a certain point, you gotta wonder, everyone talks about deficits, everyone talks about the political backdrop. When does it actually start to matter when we get the pushback? And people say it's gonna be next year, it's gonna be the year after, it's not gonna be for a while, and then we get a sloppy auction and people are saying, oh my God, the deficit. So at what point does that story have some legs?
416 on a 10-year. More of that coming a little bit later. Coming up over the next hour, Paul Taubman, the chairman and CEO of PJT Partners, joining us around the table. Looking forward to that. Sheila Kahyaoglu of Jefferies on airline earnings. We heard from Southwest a little bit earlier this morning, and Alaska Air as well. Southwest is just about positive now by 1.6%. And then we catch up with senior White House advisor Amos Hochstein on record crude production and AMH. 13 million is the number we're going to mention a few times with that man right there.
It's a record on any country ever, what the U.S. is producing, yet the Biden administration does not like to talk about it. It's like a secret that no one wants to talk about in Washington, but it's also part of the reason why, going into an election year, you have gasoline under $3 a gallon.
Yep, he's going to be talking about it later on, that's for sure.
We're going to force him.
Let's begin with our top story this morning, counting down to US economic data, GDP, core PCE, and jobless claims 90 minutes away. Investors hoping for more clues on the Fed's rate cut timeline. Bank of America and Goldman expecting the first move to come in March. Citi, Morgan Stanley have the Fed waiting until June. To talk about the outlook for investment banking and a whole lot more, Paul Taubman, the CEO of PJT Partners, joins us around the table. Morning, Paul.
Good morning.
The investment banking recession, sir, is it closing? Is it ending?
It's beginning to warm, but it's going to take a long time. It's going to take a long time. We've had the punch bowl. We've had incredibly easy money conditions, zero interest rates. We've taken the punch bowl away, and markets haven't fully adjusted.
Do you think a couple of rate cuts make a difference to your world, this conversation that we have every single day?
They do. They do. The reality is that rates right now are coming down. The only question is when, and I do believe that it's going to be pushed out further. And until we start to see actual rate cuts, I think it's going to be difficult to really get the financial markets, the M&A marketplace moving.
You said something there that I think is really telling. You said the punch bowl has been taken away, but it takes time for it to adjust. It's sort of the long and variable lags that we've debated for about the better part of about 3 years. Do you think that there is a mountain of reckoning and valuations that has yet taken place in your space, in private equity, in sort of some of the deal space?